show coming from the rack store. With this back in the Mac in the back flow. Let's go, chillin' with raccoons by the back door. Take calls so you can stake more. All I wanna do is making dough, right? But I found this crew and doing alright. We wreck, will bitch, ready to fight. So many raccoons ready for the boss life. I might fly high like a kite, right? But always ready for a shite for the right price. Raccoon supply has the right price. Giving you respect if it's likewise. So I'm buying all the mean guys with the clean heart. Read between lies, laser beam through lean eyes. Warrior with clean lies, trash mouth, mean smile, be wise. NFT wise, fuck with these guys. It's the rack rap from the back lab. 110 of these in my backpack. Crazy rack rap from the stash app. Rack will take a lead in this haystack. It's the
Good morning, RAC FM. Today is Tuesday, the 23rd of May, 2023, and this is your favorite, the best, the motherfucking greatest show ever, anywhere, ever. We are the best. We are RAC FM. RACFM.org. Finn here, gonna hand it over to your captains this evening. Bruceman, Robo, Bbandz for a sec. This is the Neck Syndicate.
Have you got any words, Bruce, for the gentlemen and everything?
I would just like to say welcome to this special first, maybe the last, we'll never know, maybe we will in the future, episode of the Neck Syndicate, joined by the surprise guest, Steven, the Cardano Tokenomics consultant genius dude. This is the financial breakdown and more reports brought to you by RAC FM.
Nice one, Bruce.
That's
probably going to be Finn's beginning, isn't it? Right, Mike. I mean, I heard all of. Oh, dude, we get better. Wait until we get really going. I mean, I heard Stephen say like his dissatisfaction in certain DeFi products and stuff like that. Mike, like hypothetically, no names or whatever. We don't have to go there. We all know the situation. I mean, what happened with this kind of situation last week with founders getting tokens, being able to harvest them, farm them? Is this unethical behavior or something we should accept, or is it a problem with the tokenomics at heart?
What's up, guys? Yeah, quick introduction. Steven, I come from a similar space with you. I was a financial consultant, still am a financial consultant. I come from the securities industry where the stuff is literally you're behind bars for plus 20 years. And if you do any of this insider trading stuff and get caught by the Securities Exchange Commission or FINRA, you're in jail. So I don't know why it became acceptable in DeFi. I think I'm starting to get to a point, and I was almost at a breaking point last week where I was like, fuck all this, I'm done in this space. This is not what I got into this space for. It was more for, the access and the open access to financial markets for most people that don't understand how hard it is to access U.S. equity markets, to access the world market. It's actually very hard for somebody. I mean, it's easy to trade U.S. stocks, but for the average person to be able to, open up a brokerage account or open up, a Forex account, it's not as easy as it is to open up, like a MetaMask or to get a Coinbase account or like a decentralized finance wallet. And that's kind of where, I started to align with it is like, okay, now you have open access to financial markets, which isn't accessible by everyone, especially if they don't live in the U.S. So back to the point of what founders are doing. Yeah, it's totally unethical from the point of where, tokenomics wise, where Eric could probably speak a lot more. Like I address this a lot and I got a lot of shit for it where, a lot of these tokenomics are predatory in the sense of that inflation is super high in the beginning, and that allows, allows founders to either stake tokens or incentivize LP. With LPs, I mean, I've been a big proponent of saying LPs lose money in traditional market making world. Market makers don't really take on that much risk because they're really finding matchers and buyers, and it's more of an order book flow. And for some reason, these AMMs, what Eric was saying, and why Astrovault's a lot more different is that a lot of AMMs are incentivized with these inflationary DEX tokens that don't really have any value other than, I mean, farming and dumping, which we saw Jake and we saw, the Atmos team. We saw a lot of people do with these farm tokens is, okay, I'm going to incentivize my LP. And this is literally the strategy that a lot of DEX tokens.
Sorry, Mike. What about governance? Isn't that a valuable utility?
No, governance is not valuable. Like, I'm just straight now. You don't see Fortune 500 companies have regular people that don't keep up with the day-to-day balance sheet, don't keep up with EBITDA, they don't keep up with any of the stuff of how the financials run in a company, make the financial decisions. That's why there's a board of directors, and that's why, you look at Ford, you look at a lot of these companies, that's why insurance companies are, I'd say insurance companies in the United States are the longest standing companies in the United States for a reason, because they know how to manage risk. So I think having people decide what the financials are is the dumbest shit that ever came out of crypto. I think everybody should have their niche and specialty on what they're good at. And I'll be no stranger to say I know nothing about, I wouldn't say I know nothing about the technology. I understand a lot of it. I don't know how to code. I don't know, a lot of the technical terms. And I think a lot of it is fleecing. And they make it seem a lot more complicated than it really actually is to make them seem smart. So they have like an edge. But I think, Eric and I talked about this, is where a lot of the shit that they were saying was like, I'm pretty sure this is not that complicated as you make it seem. And it's kind of like a Ponzonomics flywheel where, if you really had simple tokenomics, the more simple it is, the better. I think we'd be off in a lot better place. But I definitely agree with the fact that what a lot of people are saying is that, the founders should be held accountable. And I think people making excuses for Jake, making excuse for Atmos, making excuse for a lot of these founders. Well, they have to fund it themselves. Like, there's a reason why VCs don't invest in these projects, because they're probably shit, and VCs don't think they can make money. And people hate VCs so much. It's like, venture capitals are in here for two reasons: one, to make money, and two, to align with founders that align with their interests. And if you're not in one of those categories, then you're not going to get money from venture capital.
So I've understood.
Sorry, Steven. Just a quick one. So this cutthroat, no BS attitude that Mike just expressed, Eric also got it. This is very realistic, opportunist. It's my perspective. It's why Eric and Mike is gonna be hopefully a household name in the RAC FM broadcasting station. So Steven, show us what you got. No, I'm kidding.
Okay, I understood that. I understood that from a few perspectives. There's like a wide range of questions within that. First, I want to just start by saying, yeah, absolutely, founders should be held accountable. Essentially, at the end of the day, we're building a business, right? A DeFi product should be a business like any other. And being a business like any other means that you should be following the laws that any other business needs to follow in order to operate. I don't think I am unique in thinking or saying that. And that's why regulation overall for the space of, God, this is a dangerous thing to say, is in long run a good thing, because it legitimizes the space, and it means that we now have clear-cut rules that we need to follow, and we have structures of responsibility that need to be accepted. As an example, if you have an Australian financial services license, you need to have at least 2 responsible managers that work within your business, right? And those 2 responsible managers are both there for the purpose of auditing and for the purpose of compliance. And that's essentially 2 people that have the education level to ensure that your business is meeting the regulatory requirements to hold an Australian financial services license. When you're providing financial services, there needs to be some level of compliance officer, right? That's the reality of why we've created this regulatory system that exists. And it's to protect people from actions from founders, exactly as you're describing, where they're able to create designs of just a pure inflationary token that they have the majority of at the beginning, which allows them to inflate their own supply and then dump down, or, of course, gives an undue advantage to those that enter the market early. I arrive early, I buy in a lot, and next minute I'm able to dump down on the others that come in after me, hence, Ponzi-like. Yes, so that's one of the biggest problems with the design of DEX tokens, right? I absolutely wholeheartedly agree with you there. Now, and another thing that I just want to point on, though, is you were talking about the trading of liquidity pools, right? And the trading of liquidity pools themselves, let's remove that concept of a founder. The trading of liquidity pools themselves, people need to kind of adjust the way in which they're imagining how they're working as a financial product. As a financial product, liquidity pools are much more similar to interest rate swaps between two currencies than they are to trading a currency outright, or than they are to market making, right? If you think of it as market making, you're instantly going to be putting yourself in a back foot, because you're thinking that I'm behaving as the buyer, as the seller and the buyer of a token, but the mathematics of it don't behave in the form of market making mathematics, because market making works on an order book model, exactly as you said. Rather, if you think of it as an exchange of relative value between two tokens, right, or relative value between two currencies, and rather than look at it as me market making, I'm looking at it as me creating a hedging structure between two currencies by offsetting 50% of the risk with regaining the token that I'm losing, right? Much like swapping a fixed and variable interest rate, right? I swap my fixed interest for variable interest so that as I lose value in one currency, as that value in one currency goes down, I'm making back more of that currency through the interest rate. Because I've got fixed over here and I've swapped it for variable over there. So that means the variable interest is changing. Now, when you look at it within that structure, the way that I would engage in DEXs, you don't engage with, like, I don't normally engage with the liquidity pool with the DEXs token, right? I'm looking for thinking about my token structure within a portfolio. So let's say I've got a portfolio of Bitcoin, Ethereum, Cardano, BNB. Within this portfolio, I know that I'm pretty happy with having BNB and Cardano together. Like, I don't really mind if I've got a bit more BNB and a bit more Cardano. I know that I don't mind if I've got a bit more Ethereum and a bit more Bitcoin, right? What I need now is trust in a protocol that I'm supplying my liquidity to, right? But if I'm supplying Bitcoin and Ethereum and I'm trading off the relative value between Bitcoin and Ethereum while earning fees, right? Now I'm behaving like a currency exchange. So I'm earning fees by allowing others to currency exchange between me, right? I'm taking off relative value from the respective token, right? When Bitcoin is going up with respect to Ethereum, I'm earning more Ethereum. And when Ethereum is going up with respect to Bitcoin, I'm earning more Bitcoin, right? But because I don't mind holding Bitcoin and Ethereum, right, I'm probably going to be holding both in my portfolio anyway. I'm willing to accept that fluctuation in return for some kind of flat payout from the DEX, right? Now, the value of that token often is decreasing because they've designed their tokenomics poorly, right? But at the end of the day, because within my portfolio, I don't mind having more or less of either of those tokens, and I'm earning a flat return, as long as I have faith in the protocol that's underpinning that, I don't mind holding it within that liquidity pool. Does that make sense?
Yeah, got a couple questions.
Yeah,
Please.
Go ahead, Eric. You take this one.
So first off, excellent coverage. Thank you. One, why do you have a fixed supply of Wi-Fi? And then two, I get that there's like a profit sharing, but what happens when that max supply runs out, and how do you retain value of the Wi-Fi token?
Well, we don't really have that max supply running out. It's function. The farming function is asymptotic. It never actually reaches zero. Similar to Bitcoin mining in that respect, right? As for the supply, we've designed our farm to basically be doled out very slowly over 30 plus years, right? So the entire idea of the farming in Wi-Fi is that it's a slow, sustained process that takes place over a long period of time. Now, as an example,
why have a max supply as a whole? Why do you support max supplies? What is the purpose?
Why do I support max supplies? This is interesting, right? This has got more to do with the Cardano ecosystem itself. Within the Cardano ecosystem, the concept of burning tokens is looked upon very poorly. So it's very hard to talk communities through to burning tokens. It's not an accepted mechanism within the Cardano space. So since understanding that within the blockchain that I'm working, that's not a commonly applied mechanism. As we don't apply a burning mechanism, the alternative is to have a max supply that we're approaching, but we can never reach, so that we're able to control the levers, as we don't have the lever to pull out supply.
Okay. Carry on. Like, how much revenue is Wi-Fi making? How do you justify token supply? Sorry.
How much revenue is Wi-Fi making? I wish we were making more.
Right. Well, in general, like DEXs don't make money. I've been looking over your guys' white paper. Very well thought out. Love the diagrams and everything. I get that there is like a profit sharing type thing. So one, I'd love to understand why Wi-Fi isn't a security, and how you guys plan on maintaining not being a security as future regulation gets rolled out. And then two, I'm wondering like how much profit there is, like how much revenue are you guys working with? Like what kind of fees? Like is the long-term plan just to sustain itself on fee revenue? And if so, how does that pay for the team?
Yeah. So we said really nice things about governance before, so I'll avoid mentioning governance.
No, please do talk about governance. We're just talking shit. It's Cosmos.
So with respect to the securities aspect, our token X Wi-Fi is a security. We've got in Australia, we're not considered a security, and we're an Australian business, right? In America, it's definitely not that simple. Our X Wi-Fi is the one that's considered a security, not Wi-Fi itself. We've got a mechanism that if we are told that we have to, we can change our mechanism to supplying income to the liquidity itself, so that it's not adjusting any price of Wi-Fi rather than being supplied to the X Wi-Fi token. So that would annul the securities classification of the X Wi-Fi token. Wi-Fi itself isn't classified as a security, and that is something that we are watching very closely with regulation to see how that develops in Australia to ensure that we adjust accordingly as soon as the regulation develops.
Okay, cool.
Now, what was the next question? What was the next question there?
Yeah, how much revenue are you guys working with? Do you have means of adapting, adjusting, getting more revenue over time? Is it just relying on listing fees and trade fees?
So no. It's actually not even relying on listing fees. We don't have a listing fee. You just charge. It's just the transaction cost to list. It's on trade volume. It's also on NFT royalties. We've got a popular NFT project on Cardano. It's also based on our lottery, and it's based on the upcoming auto harvester, and it's also based on the. So in Cardano, there is a transaction fee that gets sent when you perform a transaction. It's called concurrence. It costs about 1.5 ADA when you send a Cardano native token, and we're also taking a third of that to go through to the bar. So it relies on a volume of multiple mechanisms, right? So what's the volume of trades themselves that we're getting? Like, it doesn't really matter the volume within the trade, it's the number of trades. It also matters the volume. That's another one that impacts the total amount that's going through. It also has a volume of our NFTs. It's going to be a really wide ecosystem when it's completely built. The current income that we're working with right now, since we launched our DEX a week ago, right? So in the last week, we're probably talking 3,000 or so Cardano that's gone through to the bar.
First off, congratulations on the launch. And secondly, sorry to grill you. I know you know your shit, so I'm genuinely just trying to understand more of this. I've come at things from a
no, please throw me away. These are the questions I want.
Yeah,
these are the questions I want, mate. I'm here to think.
Yeah, just crunchy numbers. My background's in economic philosophy. Got into tokenomics from the casino side, actually. And one of the issues I'm running into looking at things from first principles perspective is that a lot of businesses that we're just expecting are going to work just don't have the potential for revenue that are required to sustain the businesses. And one of those I've struggled with is DEXs. So I'm building Astrovault as mine, and basically we're tapping into the inflationary rewards of the layer ones through the liquidity that's hosted as a means to try to subsidize, because trade fees aren't enough to sustain LPs and whatnot. So I like your guys' idea of the flywheel.
And exactly what you're describing there is what we're doing with our auto harvester. Right? So it's to be able to access the liquidity of the other DEXs that are around the ecosystem to then be able to support that back in our own ecosystem. So you can access, for example, the MinSwap LP through the Wi-Fi platform.
Okay.
That's another DEX on Cardano.
So it's like an aggregator?
Yeah, it's an aggregator.
Okay, cool.
Sorry, yes. It's called differently on different blockchains have different names for the same thing. And that always confuses me when I've been so long in Cardano, so forgive me. We call it an auto harvester. So yeah, liquidity aggregator.
So Chris had a lot of questions. I'm just reading them under the RAC FM spaces. and it'd be okay. Can it be okay if I just answer those real quick?
Yeah, of course. Go ahead.
So you say that VCs aren't necessarily a good thing. They may not invest, and it's a good project, but doesn't mean they invest in the project's vision. They're in it to make money. What do you suggest for VCs replace dumping on you rather than Jake dumping on you? With VCs, there's a lot more regulation that goes into the VC space. In crypto, there's not really much you can do. If they are a U.S.-based VC, they do have certain rules they have to follow by. I mean, venture capital and hedge funds are regulated by Reg D in the United States, which there's some sort of best interest that's baked into there. It's not super, I'd say super rigorous. It's not like the securities industry. They're not regulated by the SEC. So there isn't really there's nothing to really prevent other than vesting schedules with venture capital, and that's really worked out between the VC and the founders. The thing about the VC stuff is a lot more transparent on kind of how much the VCs hold because they have to report it. So I think you bring up a valid point where a lot of VCs really aren't aligned with the project vision, are really in it to make money, but at least you know that VCs are in it to make money. And I think if you don't realize that, you're kind of, I wouldn't say you're stupid, but you should tread carefully where VCs are present. But then, A160 is a good one where I think Anderson Horowitz, I think they do have a long-term vision on the space. And I think I could say Delphi is in here for a longer term time horizon. So it just depends on the VCs that are investing in the projects. If it's a VC you haven't heard of, I think it's just sometimes blowing smoke up your ass, and it's not somebody that would have credibility. If you're looking at some of these projects, I'd look at more quality and I'd say non-predatory VCs. I think Jump is one of them that you kind of got to be careful with too. But I mean, Jump's invested in synthetics, and I'm a synthetics investor, and they've been pretty helpful with the success of synthetics. So I think from that aspect, I think VCs dumping on you is a little bit different than the founder, because the VCs are in it for making money. The founder is really in it to make the project and have it be successful and longevity. And then you say, who's more at fault, Jake or Stargaze? Jake can't dump early if Stargaze doesn't do shit about the distribution. That doesn't mean Jake's moral, ethical, or was a good decision. But if you give everybody liquid tokens and say don't dump on you, you're at fault. I agree on that at some point. I think it is important that founders are important on who they give the distribution to. Jake was a co-founder of Stargaze. He was no longer affiliated with Stargaze, but there was no transparency of why he dumped or why why he left the Stargaze team. That's kind of Stargaze. I think that is part of Stargaze's fault. But then again, if somebody leaves the team, you'd have to have proper vesting schedules as well. So I think it was a learning experience for Shane too. I think Shane had a lot of faith in Jake because Jake, he's building Juno, and I think there's some shit happened with the code, and they ported the code to Juno. There's just a lot of stuff that's like kind of, I'd say, gray area where it's not necessarily wrong in the sense of it's illegal, but moral and ethically it's not. I live by more of a moral compass than a regulation compass. I think the clear right and wrong in a situation. If you're walking away from $8 million and you have your community and all this, and you're kind of just like, I'd say you're more than fleecing and grooming your community. We could like to call it in the securities industry is where you're defrauding investors, where you're at the sense of you're telling them not necessarily material and factual information that's not true, but you're kind of misleading them in the sense of, you're withholding information that you know. So just because you're not telling the truth, if something like, Jake was dumping these tokens and, he was not affiliated with Stargaze, he was stealing the code, and you're still, promoting Stargaze, you're promoting Juno, I would still count it the same as defrauding investors because you have access to information you're not allowing the community to know and investors know. So I'd say from that aspect, Jake is wrong for that. Shane obviously is in the wrong too, but I'd say Shane is a lot less at fault because I think he had good faith in that Jake would contribute to Stargaze and the success of Stargaze. So I'll let Robo. Robo's got his hand up. So.
No, well, actually, I'm going to segue into something that Stephen just said. However, I apologize for the noise again. I just want to find out if Eric or Stephen's got any response to what you said about VCs before I just asked Stephen about what he mentioned there. Eric, you got anything for Mike there?
I mean, one of my major frustrations is that VCs are dumb. Just in general, like I've had some of the lowest quality conversations I've ever had in the crypto space with VCs who are just absolutely lost. And then seeing the kind of things that are on the portfolio and just trying to get them to understand things that are just so far over their head, it's infuriating.
That's why most VCs are focused in like private equity and equities markets, because that's where the smart ones are.
Yeah,
the crypto ones are failed equity and private equity VCs.
We've noticed more.
Much in Bitcoin.
Yeah, we've noticed far more success when I just don't talk to them. Maybe I'm kind of an averse person, and it could come off a little rude, I guess. But I don't know. I can actually go into like what we're building and stuff with Astrovault, and it just goes way the fuck over their head. And I get it. Don't invest in stuff you don't understand. But if what you understand is fucking monkey pictures, like good luck.
It went over I read 5 minutes in that white paper. I'm like, okay, I need to talk to Eric, and he has to explain it to me because I don't know what's going on.
Well, we're going to get into
that. I understand that feeling well, Eric.
Eric's white paper. Stephen, you got any replies for Mike?
No, like I basically agree with most of the sentiments that you guys have surrounding VCs. So like I don't really have anything specifically to add. We had a lot of VC interest back when we were starting, but I never accepted any VC funds because they all wanted control, and I was very certain that they didn't have the understanding to have control.
I think VCs in this space aren't in traditional like venture capital. And if you look at traditional venture capital in the US, it's more of a partnership where, the VCs do want control, but it's almost like private equity. I mean, you have a private equity firm, they let you do your thing, they give you a little bit of advice, they say, hey, you know what? I think you should focus more on production. I think you should do this, you should do that. Versus VCs like, here's a bunch of money. Here's what you need to do with your tokenomics so we make money. Versus, okay, we're going to make money because we're betting on you. We're betting on the founders. We're betting on the people that have the vision versus we're betting on how much money we can churn out of this project and make as much money as possible so we can move on to the next one. I think that's where I think Eric is like coming from, is that they don't have the same mindset in traditional venture capital investing, because anybody with, a large sum of money can start a venture capital raise and say, hey, in the crypto space, there's really no rules on this stuff. We can just throw money at a fire and raise money and hope to flip it in 2 seconds because there's no rules about vesting. There's no rules about, 144A where, in traditional finance, if you're an insider, you only can sell off a certain amount of stock. Like they don't have those rules in the crypto space. And I think that's why a lot of these VCs blow up, is that a lot of them aren't really smart. They're stupid people. They're a bunch of people that were failed venture capitalists, failed hedge fund managers, failed financial advisors, consultants, failed in the traditional industry. Because I think realistically, a lot of people are in the space because they failed in the real world, because in the real world, there's consequence for your actions. If I'm a financial consultant and I'm, a fiduciary and I make a wrong recommendation, I could lose my job. Even if I don't make a wrong recommendation, even if I make a right recommendation, the client thinks I'm wrong, I can still get in trouble. So I'm held to a very high standard, and I understand that. Versus in a space like this where, I know I'm speaking out of it because I'm just a fucking pixel wizard picture and nobody knows who I really am, but I'm being counterintuitive to what I was actually talking about. But I mean, I would say I'm a lot more ethical than a lot of people in this space, and I don't plan on launching a token. I don't plan on doing any of that stuff where, Syndicate is going to be a for-profit business that launches products similar to kind of like a broker dealer is. We have a slew of products. Well, I will get into that later, but I think going to what Eric and Steven are saying is that, you talk to a lot of these guys, you're like scratching your head, like, man, they don't know that I know a lot about like finance and shit. They must think I'm just some idiot guy that didn't know what he's doing, just kind of got lucky. When Eric is probably one of the more intelligent guys that I've talked in the space, and listening to Steven and his knowledge on how LPs are interest rate swaps, where I think I'm coming from a uni LP V3 short straddle, where I kind of view them as short straddles. If you look at the Uniswap V3 and concentrated liquidity and range liquidity is where you think of it more as a short straddle. But I think we have a lot of smart people in the space that don't get a lot of credit, and then they're the ones with a lot less followers because people don't really care about finance. They'd rather have somebody tell them what to do and make a lot of money. And I think that never is in the advantage of the investor, and it's always in the advantage of the founders, because I think
don't hold back, Mike. Don't hold back. Oh, you hold them back tonight. I mean, I don't know what you're holding back. Jesus Christ. I mean, you're setting fire to everybody, aren't you?
No,
You feel...
I don't give a shit, man. I really don't care. I told Eric, or I told somebody this the other day, like, if this doesn't work out in the crypto space, I'm fine, man. I have a regular job. I enjoy my job. I get to serve people every day. I mean, I love doing it. I would like to come in this space and be a greater good and make a profitable business, just like Steven and Eric are trying to do, where we have this somehow misconstrued idea that everybody's going to make it. That's not how the world works. Look at traditional investing. There's a winner and loser on every side of the trade. Whether the loser is the guy that sold the stock at a lower price and the stock went up the next day, or the guy that bought a stock that eventually filed for Chapter 11. Like, we don't know that in the time being, where somebody sells a stock. Let's say I bought, a good example is like, I don't know if you ever heard of Enron. Enron was a company in the United States that got in trouble.
I know all about Enron.
So if you bought Enron, you were the smartest investor ever before they were cooking the books. So, and you would say, oh, well, man, I put everything into it and I made a lot of money until, the new information came out that they were cooking the books. So I think, again, the person that bought the stock and it went up all the way, everyone's like, man, should have never sold Enron at, $50. Now it's at 100. Well, the guy that sold it at $50 felt like an idiot at the time, but when they filed for Chapter 11, he was the smartest guy ever. He's like, "Man, I made money on this thing."
Yeah.
when it went to zero.
It sounds like the Chinese housing market. One thing that I really want to add to that, right, is I'm always apprehensive when I see a founder whose background is marketing, or a founder whose background is, YouTube influencer, right? That to me is an instant sign that this project's probably a piece of shit, right? Now, there are one of the big things that I found within the crypto space, and I think sometimes it's done maliciously, sometimes it's done from ignorance, because the people that we're dealing with that are building these crypto instruments are very technical developers, right? Their background is development. Their background isn't economics. So when they're building these incredibly technical systems, they don't necessarily apply an understanding of economics in the way that these systems are being designed, right? And I think it's a bit harsh to say that it's always done as a purposeful way to mislead a community to take money from them. I think a lot of the times it's done and exploits are there because they're not traders who are building this and they don't understand the way in which these systems truly function, right? Like particularly when you're looking at stuff like balancer pools. Once you implement a balancer pool is highly complex. There's no way that the devs that are building that understand the trading consequences of having 14 sets of balancer pools, all of which have got shared tokens between them, and the way in which you're able to manipulate LPs, particularly, if you are a founder or hold a vast majority of 3 of those LPs, and you're able to move them between those balancer pools to be able to extract value without damaging values of certain tokens that you don't want to damage, for example, right? I tried to explain that really simply, so forgive me. That probably made no sense.
No, dude, I get what you're saying. I say all the time, we need more game theory audits. People audit the code, like, yeah, the code may do what you want it to do, and what you want it to do is dog shit. Like, you need to actually understand the first principles of the consequences, the ramifications of what you're building. Also, about the VC thing, to chime in a little bit, all the projects like, oh, well, this one's good, it doesn't have VCs. All the projects have VCs. If it's not in a pre-seed or a seed round, then it's OTC afterwards. All of your, like, oh, well, this isn't a VC chain, this is a community chain. Even in the Cosmos, they all have VC money. They all have VCs.
Bro, don't use that word community. That's the biggest bullshit I've ever heard. Community.
Wait a minute. Can we come back to that? I'll tell you what then. Okay. Wait a minute. I'm gonna do this little segue, and it's only a mini one, guys, and flatter us for a minute. Stephen, you were talking earlier, and I heard you mention the word lottery. The minute you mentioned the word lottery, I'm like, okay. Well, what kind of lottery is that, right? Are you guys employing your own form of like randomness, or are you accessing like someone else's randomness on chain, like a link or whatever? Where are you getting your randomness from if you're doing a lottery?
We were super smart about it. We were the first people to be able to do this on the chain, on the Cardano blockchain.
the way that we're doing it is we're essentially using the block hash itself to be our lottery numbers, right? So we can't predict what the next block hash is going to be.
So you said, one second, Stephen. So you said you're the first, you corrected yourself and you said you're like the first on Cardano. So did you look at like other methods on other blockchains before you implemented because we've been doing randomness for a very, very long time based on the transaction hash as well and other things. So like, when did you guys implement this?
We absolutely did look at how it was working, how it was taking place on other blockchains, the people that were using the blockchain natively to create that randomness. And then we were able to implement that because Cardano works fairly uniquely. So we had to, of course, adjust that to work for Cardano and implement that.
So you guys are not using a third party for your randomness?
No. We're using our own system to do that. But it's all publicly verifiable.
Oh, it's all open source, is it?
Not the code itself, but all the block hashes that we're using for the randomness are. So we post those block hashes with the lottery.
Right. Okay. Do you time it like with certain like prices of assets at certain specific times as well?
No, we have no need for that complexity. I could actually see a use for that complexity though within the Cardano ecosystem if you guys are able to supply that.
I tell you what, Stephen, I'll have to go and tag you. We did a randomness summit. I think about 2 months ago now, Bruce. Nearly 2 months ago, right? But
yeah, it was 2 months ago. It was the 20th of March.
API 3, we had NOIS, we had MOL, because that's what we were into, Stephen. Our project, we were a gambling project, well, a gamification gambling project, and we're sorry, the noise, the guys locking up here, and we're into randomness in a big way, right? And we had a massive summit, and the stuff that API 3 are doing is like really like high level, like way above like what Chainlink are doing. So when it comes to randomness, I'm always interested, but I'll have to send you the summit and we'll chat later about that. That might be a different show, yeah?
Absolutely. Send it through. I'd love to have a look.
Of course, bro. Right, Eric, let's get to this one, Bruce. Eric's been working, I mean, I don't even know where Eric's been. Has he been in the basement for like 6 months or something? So, Eric, give us a precursor as to what it's taken to be able to even get in the mindset of creating these tokenomics. How hard has it been? We know there's been delays with Archway. So is that one of the things, is like the developing, like what we've seen of proof of stake and how bad it's been going in some areas? Like, are you guys just literally not making it up as you go along, but is it like your tokenomics has been based on the development of what we've seen of the previous fuck-ups with proof of stake?
No, yes, not enough. I don't know. We take a lot of really good steps with Archway. It's not as many steps as I'd like to take, but again, I want to bring out cars and people want faster horses. So designing tokenomics is easy. You just think about what you want to do and you itemize the fastest steps to get there, align incentives, make sure it's safe from attack in every different way, shape, or form, and then package it up in a nice little package. Again, we just dropped the econ paper today. It is live on the website now. Where you could go over that with Archway. The biggest hiccups for me is waiting for everything to get developed, as well as then protocol changes. So I'm not a developer. When I have something in mind, like you go through the Astrovault white paper, the formulas that we use are not the initial ones I wanted. The initial ones I wanted included fractionalized exponents, and they could not code decimals in the exponents in Rust for what I wanted to do. So I had to adapt to what will also work that can be done. For Archway, I had set up this really, really cool tokenomic model with adjustable max gas per block based on demand. So similar to the EIP 1559 type stuff we have in place. Instead of just price of gas fluctuating with Delta Pog, there was also a Delta Max Gas component. And then after being completely done with this and mostly done with the econ paper based on it, they're like, hey, we can actually make the block's time recursive, where the block time is factored in directly, and then we can mint the proper number of tokens, and then we could just like set upgrade to 7 o'clock instead of random block height. And I'm like, this is genuinely way cooler. None of what I had designed can carry over to be time recursive. It's no longer safe. If you have too short of a block time, now it's going to demand more for dev inflation tokens than was even minted. Like, there are too many hiccups that we're going to have to redesign this to make all the formulas time recursive, and I had to go back and redesign everything, and that's what you see now. So that's a lot of the hiccups, just what's possible, what do people have time to build, and then since we're focusing on this, we haven't got to the governance stuff yet, where we're going to have things like actually have staking rewards incentivize securing the blockchain, which is somehow radical because nobody's actually done that. They just all say that's what's being done. So there's a lot more to do. It's just, factoring the time and then what people have time to build.
Go on, Stephen.
I just want to say I love listening to you here. I love listening to you talk about problems like that, Mike, because I've spent the last 2.5 years just going through endless lists of them. And like you just get faced with something. An example, when we were building our vaults, essentially the only way the Cardano, our blockchain, the way that we have to count on the blockchains are different because we're dealing with different blockchains, right? On Cardano, we had to deal with counting in blocks to be able to create block time. But when we're creating payouts, decentralized payouts on a stake, we can only count in units of block time. And because we have to link the amount of Lovelace or the amount of tokens we're paying out per block, we actually have to count on a base unit of time Lovelace. So our base unit actually incorporates time and Lovelace into one unit. So as I adjust my Lovelace, my time counter starts adjusting as well. And I'm starting to count on a different clock as I adjust my payout rates. So it turned out into just trying to balance like all these different decimals coming in from every time we're changing our payouts. We're also changing our basis of our time, like our clock. It was an absolute mess.
Yeah, and every time you do something like that, there's at least one more attack vector, one more layer of risk, and then you have to set up all the different fail safes that a lot of projects just flat out don't have because they're designed by developers. They're like, oh, this does this. I'm like, well, what if it doesn't? Under what circumstances does it not?
Staking derivatives.
Yeah, and people haven't even asked me yet, like, how staking derivatives work on Astrovault when we're an application, not an L1 ourselves, because L1s can have modules for staking derivatives, and we have to do things as an application, which makes it way, way harder. And we have to do it fundamentally different than everybody else. And we are. And once interchain queries and interchain accounts develop, we're going to have to migrate a lot of the stuff, and we can migrate it properly without having to redeploy pools. But we've had to set all this up behind the scenes, again, without VC money, because people are, silly. So we have done so much more than people recognize, and it's frustrating, but it's at the same time, every day is a puzzle. It's fun.
That's the fun part of building something. Every day is a puzzle. And I was actually having a chat about it with one of my colleagues today, and I was like, man, it's so incredible how complex everything we're building is. And then he looks at me and he was like, well, it's not as complex as an oil rig, is it? Particularly an offshore one.
I'd say one thing too to add on to what you guys are saying is there's misconstrued opinion in this space, and I think it comes from a place of good heart, because I think people get in the space and they want to build something they want to build, but I think we lose the plot on like traditional business. Like people launch businesses as well because they believe they can anticipate making profit in the future. Sometimes some ideas are great ideas in theory, but when you actually launch them, where are you going to find, your target market, or where you get like people don't do traditional like business thinking or traditional like somebody. You don't need an MBA to understand business. Like if you don't have an audience, if you don't have a community, if you don't have a consumer, there's no sense in launching a product. Even if you liked it and it's something you enjoy, I think it's cool in theory. Like again, like I always wanted to be a professional athlete, but like I didn't know. I didn't think it was viable because I didn't think I could make any money. Like I didn't do it because I have to pay bills and I have to, I have to live life and I have to be able to eat. But I think for some reason, these big community pools give people money to think, well, this guy has an interesting idea and he comes up with all these complex, things on how, it's going to bring back money to the chain. And if you really look at it, the bare bones of the business, how is it going to make money when that grant runs out? And I think that's that Syndicate when we were starting to think of is like, well, if we do make this Bribe marketplace for, Harbor, is it actually going to make money long term? Are people actually going to use it if the Comdex platform isn't going to have the users that we think we're going to have? And we kind of thought and stepped back and said, okay, we could think of other products that could actually be usable and make money without, VC funding, without, grants from a community pool. But then again, where Eric is saying you have to get some sort of VC involved because people don't work for free. So it's this balancing scale of where you have to have some of an idea that brings value to you and brings value to the project, but as well brings value to the chain that you're working on. And that's, I think, is the most difficult part of building is the space, is that if you don't launch a token or you don't have a place of, accountability, because when you don't have a token, your revenue is based on how much platform your revenue is based on how much platform revenue that your platform generates, not how much the FDV of your token is, not how much the value of the LP on Osmosis is, not, the value of the stake rewards on the blockchain, which Eric and I both agree are bullshit because you're paying these validators. These validators are essentially I think validators are this in my sense, and people can maybe question this opinion. I think validators in the crypto space are important because they value security, but it's no different than like paying the people at your company or your cybersecurity a shit ton of money for securing. Like, it doesn't happen in traditional business. Like, the people that provide security are important, but they're not the stakeholders of the company. They're not running the company. They're not making decisions for the company. But for some reason in the crypto space, we want to change the directive of business that has worked for centuries. And this new point of business where you have these people that are super responsible for the future of the chain, making all the decisions that don't, understand how to run a validator, no, but don't understand traditional finance or don't understand economics or don't understand all these complex ideas. And I think Atom Accelerator got it kind of right. I know it's self-elected, which I don't necessarily agree with, but you should have these separate entities that do separate things. And I think people should be responsible for majority of the decisions. And then obviously the validator should be somewhat compensated for the security they provide to the chain. So I know that was a lot to unpack, but I know Robo's got his hand up.
Cheers, Mike. I'm just going to be very honest. We're an hour in, and we're always very courteous towards our guests, as you should be. You should know where they are in the world, what time it is, etc., etc. And it's midnight for Stephen. There's something I really want the community to hear from you three big brains. And I think it's incredibly important at this stage. And again, guys, the noise here, man. Honestly, Bangkok's mental. Right, airdrops. That's all I'm going to say is airdrops. We've seen them. I'll give a bit of context. We've seen the model evolve within Cosmos. Before all you had to do was stake 10 Atom, and then you got that airdrop or whatever. Then we saw the gamification. With Stargaze, you had to buy NFTs and you had to stake some to get 20%, 20%. Don Kryptonium, who's a voice in the industry, he's very big on saying that airdrops and the way that they've been contrived is an after effect of the ICO sort of crisis and situation of 2018. So basically, he's saying what happened in 2018. We saw the ICO shit. We saw the Howey test, the security shit, blah blah blah. Airdrops are just a way for founders to be able to get round the ICO shit that we saw. I'm going to go to Eric first on this one. Eric, you've been around Cosmos with Archway. Obviously, you know the story, etc., etc. We've seen a lot of stuff. Airdrops, scam or no scam? Are there a way for founders just to be able to cash out quickly under the radar? Talk to me about airdrops, Eric, will you?
I don't think airdrops necessarily help founders cash out. What they are is they are a marketing budget where you get to pay in tokens instead of cash, which teams have a plethora of tokens and they don't have cash. So on one hand, yes, it is better to pay in tokens wherever you can pay in tokens if you are a startup that launched a token. Now, if you're getting a solid ROI, usually you're giving out a ton of tokens, and tokens are potential sell pressure. Now, you're seeing them migrate to try to set it up so that the potential sell pressure is never activated to being kinetic sell pressure, or else the tokens just get absolutely destroyed. But I don't know if that's the best way to market. I think things like Crew 3, like Bonus Block, you can probably get a much higher ROI getting the activations you need on a lower budget. But at the same time, it does also diversify. People don't care about the token unless they have it. So it is kind of this activation where you're able to grow a community, but enough people to care about your project.
Right. Okay. Well, Eric, sorry, you mentioned community. Come on, then. If you're looking at tokenomics, and I know tokenomics vary greatly, what is a required amount or an acceptable amount? Because we've seen about the community gets 2.2% and the community go fucking mad. Then the community's getting 20.2% and they're still going mad. Where's the line where this distribution actually has the impact that it's supposed to have?
Yeah, 22% is way too much. I like somewhere between 5 and 10%. That's pretty high, and if so, you definitely need to have things decently staggered. You need to diversify to a bunch of different groups. I think we just launched our Archway token distribution allocation paper. It's 6% reserved for airdrops. 4.5% will be in the first airdrop. We'll have the terms come out decently soon about what different sections of people will qualify for it, but we'll have a low whale cap. So if you've got 100,000 Atom stake, it's not going to give you any more than if you have 2,000 Atom stake. stuff like that, where you try to maximize how many people get access to tokens and lower the amount of tokens they get access to.
Eric, what's the worst airdrop you've ever seen? Very quickly, before we bring Stephen in.
Stride.
What's a oh my God, I heard that. That was really quiet. Stephen, you're up, dude.
I don't like airdrops. I've never been a fan of airdrops. I try to avoid implementing any airdrops in tokenomics unless they're absolutely required for certain reasons. With respect to their function, I agree with what Eric said. They're certainly designed as a marketing tool. They're an outlay to the project. They're not an profit-seeking endeavor. It's mostly because, exactly as Eric said, if someone's not holding the token, they're not going to care about the project. The way that I like to look, particularly when I'm looking at projects, either assisting them in designing tokenomics or looking at projects that I'm interested in, putting money towards, I always like to think of an airdrop within a context, because the airdrop in isolation is just throwing out tokens, right? So essentially it's an inflationary mechanism that's only going to push down the value of your token. For me, an airdrop needs to be implemented alongside a sink, right? So you have faucets and sinks. You got your release of tokens, you got your sucking up of tokens. What is the sink that is being corresponded with the airdrop that's going to allow that amount that's being sent out to at the same time be used for something that isn't just selling or isn't just holding and waiting to sell? An example of that is just a really simple example is a time lock vault, right? We'll pay you a flat 15% for holding it in a vault for 3 months. So then 15% or 20% of the airdrop, go put it inside that vault. That's a really simple example, and that's if it's a huge airdrop. I'm not giving specifics here that necessarily work. But depending on the size of the airdrop, you want to ensure that you have some kind of sync mechanism that's accompanying it that's going to be able to maintain some kind of stability to that total inflationary impact of that airdrop. For me, if I don't see any kind of stability mechanism being implemented alongside or within a decent amount of time, within a fairly short time of the airdrop, that to me is generally a red flag for an early investment in a project.
Oh, I tell you what, I've got Joe in the DMs. Oh my goodness, he wants you on a show, Steve. And I tell you what, you've impressed him. Like in our community, in our little world, you've impressed a lot of people tonight. Mike, yeah?
Yeah, I'll go on Eric's point is that I agree that it's a marketing budget, and honestly I agree with it, because if you can pay with cheap tokens and you instead of having money like actual dollars and paying with dollars, I like to look at everything as capex and opex. I'm a finance guy. I don't look at it other than that. I think tokens and airdrops, that's capital expenditure. You're literally spending capital to acquire users, and it's a marketing budget. I think they're done in a way in the crypto space where I don't necessarily agree with them in the Cosmos ecosystem somewhat, because you have to stake other tokens to get the airdrops. And then at that point, people can just say, well, I have Juno, I have stars, and I have these to maximize my airdrop efficiency, rather than actually believing in a project somewhat. I think like Paraswap was one that actually people hated the way it was done, but Paraswap did it when they discriminated against a lot of users that didn't really use the product. And like, you had to do a certain number of swaps and actually use the platform to get the airdrop. So it prevents, a lot of people airdrop farming. I think it doesn't prevent everybody, because some people are just absolutely malicious when it comes to airdrop farming. But I think the way that the Cosmos ecosystem it's like, you staked all these other tokens necessarily that I wouldn't say necessarily don't believe in, but, you stake to maximize airdrop efficiency. And like Eric was saying, like, the way that Stride did it isn't necessarily the best way to do it. I kind of like the way that Neutron did it, where you had to vote on, the specific proposal that launched, ICS and to onboard Neutron. So people that actually were paying attention to governance and stuff like that are the ones that are going to be able to be eligible for the airdrop. So I like it in the sense of the way that you actually have to participate, and what Crew 3 kind of does is makes people do these certain tasks to be able to even be eligible. And I kind of align with that in the sense of there's a pay to play when it comes to airdrops. I'm not necessarily against or for. I'm kind of like credibly neutral when it comes to it, just because I've seen it done in a way where it's super predatory, kind of like in the way of the reverse Dux auction with Rebus and a few of these other protocols that did it like that. It's like, well, you got this massive airdrop, now provide liquidity, and now these pool rewards are going to go to 100, and everyone is paying influencers to do all this shit. I think there's a lot of scummy shit that goes on in this space that just goes unnoticed, and people get mad when like I bring it up about like, you know, territory and all these tokenomics. And I talked to the territory founder, like I was like, listen, you guys cannot inflate the supply 500%. Well, it cliffs off after X amount. No, it doesn't make sense. Like 500% is never feasible. Like it's not like it's off revenue. If it's revenue and your revenue is that high, holy shit, man! Like I'm gonna buy your company 10 times over, no question. But for some reason, the crypto space we've gotten to this inflationary rewards mean that, you know, you hold your stake. It's not stock options. It's not.
Hyperinflation with max supply. Yeah. We're just like, get in now, well, and you get a huge percentage.
Well, no, Eric. They compare it to they compare it to like stock options. No, it's not. No, it's not ESOP. It's not. It has nothing to do with it. It's not even close. What you hold your governance power for? What? Do your governance votes really matter? I mean, a lot of people were against a lot of props and didn't matter because the validators voted opposite. I said what I said. You know, I'm done talking about it before I take this space another 4 hours.
Bro, it's much appreciated, man. This is the reason why we invited you or handled I can't talk right now. But yeah, we basically made this space on a comment that Mike wrote to Eric about financial reports and breakdowns and more reports and more reports. So yeah, Mike, just keep talking, bro.
We still haven't we still haven't seen that though. We still haven't seen any of that. As soon as like, you know,
physical responsibility, Mike. Yeah. Is that what we haven't seen? Any kind of physical responsibility whatsoever in like, I mean, Cosmos is like, you think Ethereum's a Wild West? Cosmos is down. Cosmos is fuck. I mean, this DAO shit and this like solar DAO and what, you know, these guys just like printing their own tokens out of thin air, like nothing back in the project. And oh my goodness, we are so far away from being like a normal kind of regulated environment, right?
Nobody's going to take us seriously. Nobody's going to take us seriously until there's actual financial primitives and backbones built in this industry that can actually solve world problems other than what Bitcoin's doing right now. So I think Ethereum ecosystem gets a lot of hate, but I always say this, gas is expensive on Ethereum because people use Ethereum. That's why it's expensive. It's not expensive because, you know, well, it doesn't make sense. EIP 1550. No, it's expensive because people use it. That's why people pay for gas.
From a tech perspective, I'd argue that means you should improve your scalability.
Yeah, but that's why L2s exist. And that's why ZKs exist. And it's fat protocol thesis, which I don't necessarily agree with. But then I kind of side more with it because the at-chain thesis doesn't require you to have a token, but a lot of people think that you need to have a token. And I think that's what ICS is solving a lot of. And you see Noble and a lot more of these chains. And the people that argue that you need a token are kind of the ones I'm like, you know what, there's a reason why they're doing this. And I don't necessarily agree with it because they don't believe that their company can be profitable in the future. That's why they need a token. And that's where I kind of align with this. If you think your company's going to be profitable in the future, your protocol, I like to say company because I view everything as a company. I mean, if you're an enterprise and your expectation is for profit, kind of like, I think when you're investing in a token that doesn't have revenue, you're expecting revenue in the future. And I would compare that to growth investing and traditional investing versus like a VE curve position or a curve position where there's already revenue being distributed and you already know revenue is going to exist. So you're not going to see the multiples because, you know, people understand that there's distributed revenue versus, you know, you buy some meme token. I wouldn't call it meme token. Let's say you buy a DEX token, like let's say Wi-Fi, you know, Stephen, to compare your company to example, a protocol. You know, you said that you aren't making as much revenue as you think, you know, as you think you should. So if I'm going to buy Wi-Fi token, I'm assuming that you're going to have more revenue in the future, meaning that I expect the token price to appreciate significantly once that revenue is present. That's no different than, you know, growth investing in today's market where, you know, Tesla or all these companies, you know, they're making money now, but in the early days, I mean, they weren't making any money. I mean, if you look at the EBITDA of some of these companies, like they had negative billions of dollars of revenue per quarter. It was nuts. So I think that's kind of where you have to look at it if you're going to buy a lot of these projects that, you know, don't necessarily have revenue that you expect that they have revenue in the future. Atom is in this category where ICS and all these other features that are being added to it are going to be future revenue for, you know, the Cosmos token, which as of right now, the only thing that's keeping it alive is its security and its market cap. and the inflation rewards, but there's really no revenue other than, trading. And I mean, I don't know how much revenue Atom generates, pretty much nothing, but ICS and all these other revenue streams are going to give it more value in the future. But Eric, you had your hand up.
No, just giving a thumbs up. Yeah, I agree with a lot of what you're saying. But again, there's lots and lots more to go on, but we can always have more spaces. Steven, it's been awesome talking, dude. Really appreciate your insights. Yeah, I would love to dive more into on what is like future investing. Most things, if not all things, I believe would run more efficiently with a token. That being said, tokens are not right for everyone, but what we're seeing done with tokens is infuriating. Same with what we're seeing done with what's super cool about the tech and NFTs. I'm not a fan of how they're just being used right now.
The biggest issue that I think, just to change to NFTs for one really brief second, and also tokens themselves, I think one really big regulatory hurdle that we really need to face is how are we able to actually apply contracts using assets that we have on chain. And until we have a regulatory, and you could have an entire space discussing this question. I've been in multiple workshops where we're discussing this very problem, the entire bloody thing. But essentially, like if I purchase a home using an NFT, how does that NFT actually convey the responsibilities of a homeowner just by holding it in my wallet? And it's very difficult to apply NFTs as financial instruments until we actually have, clear regulatory guidance in which we can actually say the blockchain is behaving as a contract to a certain degree on a legal perspective.
Yeah, well, you need to get local governments on board. You have to there's a lot of third parties that need to be on board because like a deed to the house and stuff like that's a very complex idea. I'm just talking about the United States, but like there's governments, there's stuff that that have to be incorporated in this infrastructure. And I think that's what Canto is actually trying to do in Nashville. I mean, they could speak more to it than I could, but I think that's the direction where you have to go, where you have to get governments on board. Like there is no privacy, I mean, that stuff is, I understand privacy is very important and, your keys, your crypto, of course, but to operate without governments, to operate without, the structure that we currently have, I don't necessarily think that's the right direction, because then you come to a point where there's a few people making the decisions that hold a lot of the, stake in the network. So, yeah, sorry, I got sidetracked, but go ahead, Steven.
No, there's nothing to apologize for, mate. One of the things you just mentioned there, this is an actual sidetrack that actually blows my mind. In America, you guys run all your housing through local governments. So it's the local governments that control, you have to go to the local governments to put in all the papers, and each local government controls who owns the house independently.
No. I meant in the sense of like property taxes, stuff like that. Like you can get your house taken if you don't pay your house tax. That's what a tax lien is. So I'm talking about more I'm talking about in the more of the part of a third party having a claim to property tax. Like if you live in a city is a good example. So I'm assuming most people understand, living in a city, you pay property taxes, you pay water, you pay electricity, you pay all these utility bills. So like the deed to the house is important. Of course, the ownership of the deed of the house, unless you're going through a bank or unless you're going through a mortgage or all these other instruments that you have to go to buy a house. Not everybody's buying cash. There's more than one party that's involved. So it's a good idea in the sense of real estate and stuff like that. But the actual quality of life improvements, other than like, okay, if you could change closing to, a week or a couple of days to close a mortgage, great, huge quality of life, because most mortgages take weeks to close versus, well, now everything's on blockchain. Now I have to worry about all these crazy third parties that I have to distribute. I think it's a lot more complex in real estate, because I think when you own a property, it's a physical asset and you're in a community versus, like Bitcoin, which is a currency, and currency is meant to be spent. I think you're on the right track, and you are right where it comes to, ownership of real estate and stuff like that. But NFTs are not at that point where there's still third parties you have to deal with when it comes like the deed to your house. What happens when you sell your house? You don't have to give up that NFT. Who says you have to give up that NFT? Nobody. I mean, really, it's a physical, cool thing that you own. And yeah, here's the deed to my house. It's on blockchain, but it's no different than scanning it and putting it in like a Nord locker. I don't see the physical benefit of doing something like that. But maybe somebody can educate me, because I'm not a real estate professional.
No, you're absolutely correct. You're absolutely correct. There isn't any. And actually, more the thing that I just wanted to say was in the real offside thing that I wanted to say is that in Australia, we have a centralized system that manages all of that for us called PEXA. So all of all of these ownership systems are already managed in one place, which makes our life super easy here to change ownership. It does also mean that the government controls all of it.
That's the problem. I think that's a massive. I mean, not everywhere is perfect. Don't get me wrong. Like the United States has a high crime rate. There's a lot of shit wrong with the U.S. But I've been a lot of places, and I can't say the U.S. is my favorite place. I mean, biased, obviously, but I think every government, every country is going to have their own problems. Like it solves a lot of quality of life within it, which is in the United States. There's a massive barrier to entry for a lot of people to buy homes, you know, because it's credit score, and then you have to worry about your debt to equity ratio, and there's a lot of shit that goes into the home buying process and all this stuff that necessarily doesn't exist in other countries, which I mean, I could be totally wrong, but I haven't been buying houses in like Portugal or Australia. So I know.
Well, I've gone through the purchasing process through an Italian bank and through an Australian bank, and I can say it was surprisingly similar. But then again, we're all common law countries, so the basis of our contract law is essentially, you know, philosophically, it's the same thing.
I'd like to stir the pot here and change direction. I will admit when I'm wrong on something, and I think that Joe's in the room, so I do owe Joe an apology. Where I was advocating for a lot of DeFi stuff and DeFi tokens, and him and I were kind of having conversation about DeFi tokens and NFTs and how most of the time, you know, like what NFTs are somewhat rug pulls and which DeFi project. I'm like, well, a lot more DeFi projects solve a lot. Honestly, I view them as the same thing now. I think a lot more DeFi projects are rug pulls and have these complex mechanisms that aren't necessarily, I'd say, fair to judge, because I get confused, and I think Eric can probably jump on this point as well, where a lot of these mechanisms seem really smart, and then you break them down and you're like, this doesn't make sense, versus like an NFT project, you know, you're just kind of gambling to hope. I mean, it's just simple, you know, trading. It's like I'm buying this NFT either that I like it because it looks cool, or I'm buying it in the future to hopefully sell it at a higher price, versus DeFi tokens, which is like this mechanism makes you get a share of revenue and then you get a boost. And this, like, you know, it's just, you lost me at hello.
Money comes from somewhere, and people want new because it's new. New's not always good. I mean, that's what I've been saying about Atom 2.0 tokenomics, and I still can't get a message back from the Atom Accelerator DAO. Guys, we would love an email back if anyone can relay this to them, because I cannot get a message back from them.
I think
Blockworks is working on their tokenomics, which I saw, you know, whatever his name is, Effort Cap, tweet something about Atom 3.0. So I think they went with that route, Eric. I think that's probably what happened.
Atom 3.0, is that where you increase the community tax via a prop, like later in the day? Then you can fund like what you want?
I don't know, man. I think the Blockworks guy, I think if it is Blockworks, that's great, because I think they're one of the few actors in the space that comes from traditional finance. So I think I mean, talking to them, they're generally smart people. Like when I mean,
I agree. I agree.
Actually smart, not like pretending to be smart. And
I agree.
All these technical, you know, loopholes. I think they're actually financially intelligent.
I agree. But what was 95 a kind of civil attack on the fact that 82 got voted down? Given if you, I mean, Eric, I'll go to you first. If you look at the community the community tax increase, was it a stealth, like, you know, the 82 failed, so the stealth in 95 and got what they wanted? Is that correct or not?
I don't really understand what you're asking. I'm sorry.
Oh, sorry, dude. So there's a lot of us that think that, like, Prop 82 with Atom, right, which was the main one, yeah, Atom 2.0, Prop 95, which was the accelerator DAO, combined with the prop that raised the community tax, like that. Yeah, a lot of people feel like
100%. It's 100% for them to just force Atom 2.0 down everyone's throats. It's literally run by the people who proposed Atom 2.0.
So it's a civil attack. It's a civil attack. Yeah. Is that right? Okay.
Yeah.
Joe, I mean, Joe's come up, guys. I did invite Joe because also, I mean, Mike mentioned him, but he's one of the most relevant voices in the eco. I invited him out like 20 minutes ago. Joe's going to come in here with something dynamite for you guys. Joe, hello.
Hey, just wanted to say I've been listening. It's a great convo to just be in the audience and hear these guys weigh in. So, I don't have anything crazy to add.
Joe, was 95 a civil attack on 82?
Are you talking about the tax increase, like a knee-jerk reaction to 82 not passing?
And then 95 afterwards, yeah. I can't remember what the community tax prop was, but it was like Do you regard that as a bit of a Sybil attack? People not getting what they wanted and forcing it through?
The way that I have always felt is if the validators want to take their own revenue and pool a percentage of it together to fund all these ideas, there's no one that will stop them. The problem that I have is validators with almost no skin in the game using 1000x voting leverage with other people's tokens to force, basically take money out of the stakers' hands and use it for their own ideas. I think they should fund their own ideas. And if they have to raise their validating fees to do that, there's no problem there, in my opinion.
I wonder if Stephen can just maybe enlighten us a little bit. Stephen, what's the situation with like developer funds and grants and governance on Cardano? Like, can you how does it work?
We've got absolutely so many of them. Most recently, we had a situation with a project called Liquid, where Liquid realized that they designed their farming, their lending protocol, and they designed their lending emissions, their pooled emissions, completely incorrectly. As a result, they decided that they were going to pause all the pooled emissions to the community. But whilst they were pausing all the pooled emissions to the community, they continued giving the team their regular monthly payouts. So essentially the entire community just went, wait, what? So you basically just stopped paying us out rewards for providing liquidity and you're just taking all the rewards for yourself and dumping us. And their token went from being the second ranked on Cardano to now the 20th.
Wow. So you've got as many problems as we have. Okay. Yeah, Joe?
Sorry, can I weigh in on Liquid? I think the Liquid team very early on positioned themselves, even before Cardano had smart contracts, as the expert DeFi platform. They were going to build all this cool stuff. People waited 2 years for the protocol to actually launch. They started selling NFTs clearly to fundraise with no actual benefit. The person in charge of Liquid is also an advisor for Sunday Swap, which was a DEX that launched early on, maybe the first DEX. And I don't trust anything. I don't trust anything coming from that team. Sunday Swap to me is just an extraction of value out of Cardano. And this guy that we're referring to, he was an advisor for Sunday Swap. He was involved in another protocol where he sold tokens that were supposed to be vesting ahead of schedule, lied about it, got caught with on-chain data. So he sold 200,000 Cardano's worth of Indy that he wasn't allowed to sell due to vestiture. And he lied about it. Somebody went through the transactions and found it. Cardano's really the Wild West as well, I would say. And it just doesn't have to be this way. It's when you have like a bunch of people that are 20 something years old that claim to be reinventing the financial system because it's so much better than fiat with absolutely no experience and no track record. People put their trust in it. Oh, there's a token. It must be good. Oh, it's new Sorry, I interrupted there. That was rude of me. No, go ahead. Good.
Go on, Stephen.
I just want to say another thing that I've really noticed, within that, even Sunday Swap, right? Sunday Swap had their entire deal that they had with, I believe the name of the one was Cardstarter, where they basically, Cardstarter was building a DEX, and then they said to Sunday, they made a deal with Sunday Swap where they said, we're going to stop building our DEX, and instead we're going to merge all of our liquidity with your DEX. And in return, we get, I believe it was 20% of their token supply, something like that. I don't count me on the numbers. It was a large percentage. And then at the time of merger, I think at the time of merger, Sunday Swap basically just turned around and said, we're not going to honor our contract, and we're actually just going to give you 1%, and all your liquidity can get stuffed and screw all your community. I mean, things like that. It's really acting as an adult within a business, right? You need to treat it like an actual business. You can't act as, like you said, like a 20-year-old. It's like, oh, we made a deal, but we're going to renege on our deal. No, you're a business. You've made a contract.
And notice, I'm not going to use the word rug pull. I don't think these are rug pulls. I think they're just planned really badly with a bunch of inexperienced people who happen to be...
They're stupid kids.
Yeah, I mean, they turn into rug pulls after when the rubber starts to meet the road, they turn into rug pulls. And it's unfortunate because I stopped dealing with Cardano after interacting with the Sunday Swap team a few times. I was like, man, these guys are liars or they're really stupid. And they're probably both. And they will never answer questions in their own Discord. They lie about the tokenomics. And then when I realized, like, oh, wait, this is the same team as Liquid, the same guy that's involved in Indigo. I said, this is just one dude who's connected into everything, doesn't know crap.
What was the guy on Solana that did that? It was like one guy in Solana made like 20 apps. But Joe, literally, you hit the nail on the head, and people get mad at this. There is something to say about work experience, about life experience that you can't teach. You know, I don't know how old a lot of people in here is, but you know, Steven is. You can't teach years of being at a hedge fund. You can't teach that. Like you can't be. You know, you can't teach being in 10 years of, you know, I've been in the financial services industry for 10 years. Like you can't teach that. You know, there's people that are 10 years ahead of me that stuff I won't know that they have work experience and have seen and dealt with shit like that. It kind of reminds me of the Rory Cap and Faye situation where you had these young developers, Joey Saldano and the Rory Cap guy, I can't remember his name, where you had these young brainiac kids that were super, super smart and everyone's like bet on these young guys. And then it came to a point where, you know, there's a hack, there's a Rari hack, and you expected these guys to act smart and act like they knew what was going on. And as soon as that happened, the Rari Cap guy said, "Fuck this, I'm running away." It's like, well, you're the smart guy that everybody was betting on. Like we thought you were really smart. You pictured you as this really smart guy, and you're 17 years old, super coder, web developer, you know, brainiac kid, but you know they lack life experience. And I think that's one of the things in the crypto space where I think we need to realize that, you know, there's a lot of pressure on younger founders and they need to understand it's okay to have other team members. It's okay to ask for help. It's okay to build a brain trust of people that are really smart around you. Like, I don't know why people don't do that more.
Absolutely, Mike. And it's a thing that we have, it's a topic that's been up many, many times. Like the crypto and the Web3 space is so fucking unique in the way that there's so much money in the hands of people with so little life experience, so little business experience, so little financial knowledge. Also, I just want to make a quick shout out to a very special lady down in the audience. She knows who she is. Anyway, man, how do we onboard more financial experts into the space? Like the three guys we have here, right?
I will say one thing is that, Steven, I'll take this question real quick, as the people that aren't in the space are not in the space for a reason, because they have good jobs outside the financial space. And that's why there's not as many financial people here. And like I'll say, and I said this before for the people that aren't in the audience, if it doesn't work out in crypto, I will be completely fine. I love what I do on a daily basis. I get to serve others. I understand, you know, finance. I get to help people save for retirement. I enjoy what I do every freaking day I wake up in the morning, you know, and I'm a business owner, so I get to work what I want, you know, when I want. I'm in the space for truly one reason: to help contribute to the greater good. And if it doesn't work out and Syndicate doesn't work out, nobody gets hurt other than Syndicate, because there is no token. So there's no fiduciary responsibility to, you know, people might get mad that like, oh, this product sucks, then don't use the product. You know, it's not like you have the token and you're anticipating the token to go up. Syndicate takes all the risk, just like a traditional restaurant business, just like a traditional, you know, software business or any other business. You lose based on people not consuming your product, not the stock price or token price. Go ahead, Steve.
Let's get Stephen in before we bring Lord Cephii in. Go on, Stephen. What's your reply?
Well, I've got two replies now. The first one, it's the myth of the young entrepreneur, right? You always hear news stories about the young entrepreneur, but it's not actually much of a real thing. The average age of a successful entrepreneur is in their late 40s to early 50s. The reason for that is because it takes you 20, 25, 30 years within the industry to build the wealth of knowledge that's required to truly differentiate yourself in some way within your chosen field, and to be able to apply that knowledge in such a creative way that you're able to build a product that builds a competitive advantage over others. That's not the myth of the young entrepreneur is something that pervades the common mythos, and it's something that is incorrect. It just doesn't bear itself out in reality. The next one is, I absolutely understand what you're saying, mate. Absolutely. The biggest gap to getting people like ourselves working in this industry is that if you've got a successful career, it's like there's not a huge incentive. I've taken a massive pay cut coming to work in this industry and running my own project, right? Like I would make a lot more money working in private industry than what I make now. And I don't regret that decision, because, you know, you do get to live a life where you're building something that you love that's yours. But at the same time, you know, if you enjoy the work that you're doing and you're doing something that activates you, the amount of stress that you have to take on to become a project owner is very high, and it's often not worth the payoff. even if it is successful, to just being able to do, your job as, going to corporate, if you're a lawyer, or if you're a accountant, or if you're a trader, if you're an investment banker.
Yeah, I respect that too, because it takes a lot for somebody to come in the space, and honestly, like, the chances of succeeding is very slim. And it takes a lot to be the man in the arena. It's one of my favorite quotes, is that, the glory doesn't belong to the people that say, the guy, you failed, you couldn't do this. It belongs to the guy that actually took the risks to go and do it. And that's why I have a lot of respect for people like you and other builders in the space that are actually in here to say, you know what, let's give it a shot. And if it doesn't work out, great. At least I tried. And that's kind of where we're in that same mindset of where, we don't want to launch a token because we don't want to have the fiduciary responsibility of, taking token holders' opinions and stuff, because again, we're just in here to make money and build a product that onboards users and gets more people familiar with the space. So hats off to you, Steven. I do appreciate, people like you in the space that are building, products and taking a pay cut to do something that you love.
Thanks. It means a lot to hear. It's a lot of work, and you don't know if it's going to pay off. And it's about the love. Like, I am very passionate about DeFi. And I guess, you guys were discussing this earlier. I do believe that DeFi can act as a force for good, as long as it's designed correctly and implemented in a way that's a force for good. I mean, it's very much like any other tool where, I can use a hammer to beat someone's head in, or I can use it to build a house. So and that's where I agree with what you guys are saying, right? The biggest problem we have right now is that, particularly through governance structures, or through the way in which the communities discover projects often, whether that be through influencers, and the general understanding of tokenomics within the industry, essentially makes it a lot more difficult for the average person who wants to build a project to be able to make or implement this hammer for good. Right? Because we don't have a consensus understanding in the best ways that these things should be implemented, or we don't have a consensus understanding in how these economics truly play out on a large scale, because we're still smaller than, Apple for all of crypto.
Oh, I love Stephen, I love Stephen. I tell you, I was in the DMs with Stephen like for 5 minutes or something. Then we were talking about the civil war in Cambodia. Like, he's such a nice guy. I'm telling you, you can tell these people how nice they are. Guys,
absolutely, Robo. But I don't think that you love Steven as much as I love Eric.
Oh, anyways, Eric's biggest fan. Oh, Eric, Jesus Christ! I mean, you were his first interview. The first love. He's proper love. We would say in English, fuckstruck. But I mean, I'm not going to go there. I wouldn't do that on a professional basis. Your man Cephii's come in, and he's always on point. Cephii, you've got three big brains up here. Have you got any questions? We didn't want a diatribe. We want a question. So.
No, I think a couple of things. Like Steven's on, when he mentioned much earlier, maybe, I don't know, it's been about 45 minutes ago, about the token sync concept. It's like, yeah, if you have a way with anything from airdrops to anything else to create some sort of demand and holding pressure for the coin, that makes sense. Like, it has some, performance function, or like, and if the function is simply to like engage people on the platform, that's one function. If the token is used to play some game within the system, that's a different thing. If the token is used to buy something that people want, whether it's an NFT or whatever in the future, whatever, like, these are sort of demands, that might come in the digital space where you tie the token to some sort of demand. Okay, like, that's one thing. The second point, Robo, you were mentioning about Atom 2.0, like, just because a proposal on the first run doesn't pass does not mean you can't put the proposal forth again and again with revisions. So I think what happened with Atom 2.0 is the criticism they got was, well, if you put all these things together and wrap these half dozen things into a big package, there's no oversight, and we need to like break this up into little pieces. So pretty much with the community feedback, that's what they did, is they kind of redesigned everything and then kind of attempted to kind of deploy things in smaller chunks. So I think what all you're seeing from that is just what the community asked for on the various forums and whatnot. It's not up to the people who want to do something to give up just because the community says give up. You can always revise things and then float it again. And if it doesn't pass vote, it doesn't pass vote. That's just how life is. But like, it's easy, I think, relatively speaking, to be a naysayer about everything all the time. Most people that do that all the time just basically just have fun staying poor. Like, if you innovate nothing and you accomplish nothing, that's also kind of like a pointless. Like, if you want to be Don Kryptonium, for example, and just like be negative all the time, guess what? You're going to stay poor. That's how life works. Like, if I was a naysayer about Apple, if that was a naysayer about Apple, I would be poor now. If I felt like, modern medicine is never going to work, and like I didn't become a doctor, I would be poor now. If I, like, you know what I mean? Like, you could come up with hundreds of reasons. And by the way, like in the early computing space, like, you know, a lot of computer companies went to zero, literally. And so like you will have some winners in a space over a course of 10, 20 years. And most of the companies and businesses around any new tech are going to die. Even if they're run reasonably well, they're going to die. Like, you know, like Nokia, where are they at now? Yeah, exactly. Rest my case. Basically zero.
They're dead.
Right. So they were producing good products. They were producing good revenue, but like staying power and all of that is a difficult thing to achieve for anybody. And I think the natural like life and death processes of these things are pretty normal. And, you know, the tokenomics that and all these things that don't work for specific things or don't achieve the desired endpoints will simply die. And that's fine with me. I don't have a problem with that at all. I think as many people playing around, the better. And as many as people lose money, the better. Like, that's just how life works. Like, if I go into Las Vegas and I win every time, right, we're all fucked, basically, right? Like, that can't work.
Well, some bold statements there, Cephii.
Well,
I mean, Eric's the man.
Well, if that happens.
Yeah. Well, I think
Eric's the card counter. Wait a minute. Eric's the card counter. He's a Vegas man. So, Eric, I mean, are we in Vegas or not?
I would not insult Vegas that way. We're in the .com bubble.
Is that worse or better?
Oh, worse. Vegas is fantastic.
Worse.
Vegas is fantastic. Yeah. I mean, how many of these experiments do you guys think we're going to see in 10 years? Realistically,
I think 99.9% are going to die, and like you'll see Google, not Google, sorry, Microsoft and Apple. Like you'll see two big emerging companies that
exactly,
and Amazon, like three big I mean, and then you'll see some smaller protocols succeed on. I think I'm talking about chains and succeeding. I think a lot, like through 2 or 3 chains, will really hold like 90% of the TVL in the space.
Ethereum, Mike. Ethereum,
yeah, I do think Ethereum, whether people think I'm an idiot or not, I think I'm a survivalship bias kind of guy. If something's been around for a long time, I think it has a better chance of succeeding. It's kind of like Bitcoin. It's not sexy, but it works. And Apple continues to innovate. Microsoft obviously continues to innovate. But when you talk about a sense of currency, like, you know, why hasn't a competing currency came up to the US dollar? Because US dollar has been around for a long time, and it's been strong.
The US dollar has also been backed by the strongest military in the world.
Yeah, exactly. Well, I mean, that's a different argument. You want to argue,
but that is the reason. That is the reason why we build
dollar.
Like,
yeah, well, Cephii, there's Cephii's point in case. That's why you build missiles. That's why you build a strong military, is to back your. A dollar is a bad example. I'm sorry, but you get the point where I'm saying with something that's been around for a long time. It's like penicillin is a good example. You know, penicillin was invented. Cephii, you could probably, speak on this more than I can, but it's been invented in a long time, and it works. I mean, it
actually came from tar. You know, coal tar. Penicillin actually came from coal tar, believe it or not, in the 1800s. Quite an interesting story, penicillin, isn't it? Oh, it was a penicillin. Oh, sorry, paracetamol. Shit, I fucked up there. Paracetamol that came from coal tar, right?
Penicillin was Howard Florey, an Australian scientist that was the one that was able to get the first synthesized form.
Hey, you Aussies invented some right mad shit. I didn't even realize until I moved to Australia. You invented the air.
So Robo, before you go into full Australian mode, because I know you, bro. You can just pivot everything into Australia and talk for it for hours, man. On in. We love you.
But yes. my point is this, though, that I agree with what Eric is saying, and it is the .com bubble, and you will have emerging winners. The applications, I think it's different than the .com bubble, because you have applications built on top of these internet protocols. I think it even gets slimmer with that as well. So you'll see 99.9% of layer one blockchains fail, and there will be a few that control a lot of the TVL, and then some niche market ones. And then on top of the applications, you'll see like 3, 4, 5 protocols control, most of the TVL, most of the business. So what those protocols are, zero idea. I'm taking bets like everybody else. So
I want to add a little bit of that's of course what's going to happen, but that's a consequence of the design of markets. Markets have always got to pull to the center. So regardless of how you design any system, as long as you're doing it based on a market economy, you are going to wind up with the suction to the center where a few people or a few companies control the majority of the power. And that is just a consequence of the mathematics of how markets work. So unless we can really sort of think of a way to destructure crypto from a mentality of raw trading, and somehow think of crypto more within a societal integration or within a manner in which it's being used utilitarian rather than being utilitarian manner, rather than just being used as a financial instrument, I think we're always going to find ourselves with that natural consequence, right?
Yeah,
I was going to
say, that's why, a lot of what I talk about is the game is wrong. The game is what has to be redesigned, because without the proper game theory, you really just go to what Steven was saying is basically just monopolies and duopolies and triopolies, which is the standard for pretty much all of the tech world. It's a standard for almost any industry.
An oligarchy.
Yeah.
An oligarchy. Yeah.
And Eric, sorry, I was just about to call you just the neck. You're the game theory guy. How can we fix it, man? How can we apply better game theory to this problem?
Earlier in Mike's, you start at the end. You start with the goal. Earlier in the conversation, Mike had talked about how he'll trust NFTs when they actually can have enforceable contracts, and instead of just a deed NFT, but then there's still actually deed when there is actually the deed on chain. We do know what kind of problems at this point crypto can solve and will solve. It's a matter of bringing those to light, discovering new problems that it solves, but also bringing the problems it's supposed to solve and actually solve them and actually get integration, and then being a part of the projects that do that. The crypto framework 10 years from now looks very different than what it looks like right now. We all talk openly about 99.9% failing, but then we're all shocked when things like Terra Luna collapse. So we do have to know what the
Well, hold on. If you're going to do a stable coin, and Cephii can agree with me on this one, it has to be under collateralized, because there has to be a way for there to be arbitrage, number one, seniorage, and there has to be a reason to hold it. Over collateralized stablecoins don't make sense when the interest rate for money markets is 4.5%. They don't.
All of the stable coins we have are under collateralized. All of the over
not USK. Not USK. Wait a minute. USK.
I should have never opened
easy
my
boys.
mouth on that.
Easy boys. Everybody easy. Okay.
The issue with an arbitrage design for a stable coin is that if you implement an arbitrage design, there's always going to be some net value that's able to break the arbitrage and the system breaks down. Right? Your only hope to maintain that system is to have the hope that no one will ever be willing to put the amount of money that it's required to break that arbitrage. Right? But there is going to be a point where that arbitrage is broken.
Yes, I've only seen one stablecoin design ever. I've only seen one stablecoin design ever that I've actually liked, and it's DJED, DJED.
And 400% over collateralization, exactly.
Yeah, and they understand when it does get under collateralized, and they make the math public about it's over collateralized for now. These are the circumstances under which it breaks down. Meanwhile, what we have in the Cosmos ecosystem is a whole bunch of tokens that are collateralized by illiquid tokens, collateralized by value, not by liquidity.
Explain, right, Eric, wait a minute. Explain USK then for me. What's your issue with USK? Isn't that over collateralized?
It's over collateralized by value, not by liquidity. So my whole issue with Terra Luna wasn't that they printed their own collateral, but that their collateral was based on the valuation of Luna, not by the liquidity Luna had access to. So $22 billion worth of value, worth of market cap for Luna, but you have maybe $100 million of liquidity, dollar-based liquidity that Luna had access to. It means that you really were about 5% collateralized, and know that once you access 1 or even 0.5% of that liquidity, it's going to cause a spiral to take away the other 4.5%. So
have you looked at USK, Eric? Have you looked at USK? Have you?
Yes, I've looked at USK.
How did you look
that's
at it? Hey, it's closed source. I'm just fucking with you.
I'm not a dev anyways. They're collateralized by Atom, and like, yes, I'm happy when it's USDC and USDT, assuming that those versions of USDC and USDT are able to retain, like, hopefully, like, you don't lose Axelar access and stuff. But like,
isn't it
Cosmos is the
collateralized
only
by
actual liquid token there? And even that,
it's collateralized by. Well, all right, okay, you're talking about Axelar.
It's complicated.
Right, okay.
It's complicated.
Over-collateralized.
Go ahead, Eric.
Yeah. Over-collateralized stablecoins cannot and are not designed to scale, and they shouldn't scale. Like that, where does the money come from? They're the least efficient. Like I told people I'll make my thesis known on over-collateralized stablecoins eventually. The only applications or groups that genuinely it makes sense to launch an over-collateralized stablecoin are groups like Astrovault, which we're not even doing this right now. Maybe we will sometime in the future, but because we have our own autogenic treasury, where we can then do self-liquidations when those circumstances show up, where it shows that it is genuinely under-collateralized. So not only will be like, oh, it's collateralized at 400%, but also we can self-liquidate up to 70%. Stuff like that. It has to be centralized. And even then, why would we choose to do that? Like, it is an incredible, inefficient use of liquidity. You have to have the liquidity in multiple places at once, which you can do, but then you move money around the same way that traditional markets do. So you have to understand the liquidity leverage and value things based on liquidity instead of market cap.
Yeah, I agree with you. I think most CDPs are euro dollars. Like you're basically relying on another instrument. Layer of risk, sorry, one more thing, Stephen, before you go, is every layer of risk that you add on is more risk. It's more risk for the stablecoin versus like a traditional USDC that is backed by US Treasury bills. So why? And it goes in the sense of like, why would somebody hold, the coin that has a lot of risk, a stable coin, a good example, when, the free risk interest rate right now with traditional markets is 4.7%. It doesn't make sense. So I think it's a good idea in theory, like you're saying, but the problem is that there's got to be it all is RAR, like risk.
Yeah, who's this theoretical customer?
Go ahead.
Yeah, it's like, who's this theoretical customer who's going to hold it there without any interest?
Risk-adjusted return. That's all it is risk-adjusted returns. How much risk am I taking for holding something? What's the reward? If it's already a fixed interest rate or a variable interest rate that's not higher than the risk-free rate, which is the U.S. Treasury, which any money market you can get right now, you get around 4.6, 4.7. It does not theoretically make sense to hold something that is going to give you less than that, and you're taking a lot more risk. It is any hedge fund manager, or any risk manager, financial consultant, advisor, whatever you want to call them, will look at you and like, you're an idiot. Why would you do something like that? But for some reason in the crypto space, people are like, well, it's decentralized. Well, what's the risk? The risk is that it depegs and it goes to zero and you lose money. Day on Phantom just had this problem. It got exploited. So, I mean, I side with Eric on this.
I'm gonna put the hand up, not put the hand up, obviously, because I look like a pleb if I do that. Stephen, I'm well aware it's like 10-1, guys. He's in Australia. I've lived in the same city as the guy. It's 10-1 a.m. in the morning. Stephen, yeah, you got any feedback for that one?
I'm enjoying the conversation, so don't stress about the time.
All right, then. Sorry.
No, that's absolutely fine. No. The only thing I have to say is I absolutely agree with you what you're saying about Jed. I had I was actually having the exact conversation that you were having, or a very similar one with the designer, with the head engineer at Jed at the Cardano conference 2 years ago or so. And the way that they pegged it to liquidity is absolutely brilliant, right? It is depegging to the upside, but that's a known risk that we're going to experience, right? And at least from a community perspective as well, if your Jed gets a little bit more expensive, they don't feel as upset as if it's getting a little under. Let's be honest. Anyway, yeah, I agree with you. I really like Jed's design. Jed is the only coin that I can see that's algorithmically based, but makes sense.
By the way, this question of under and over collateralization, I think in the real world, this has been already sorted out in the sense that this is the reason why the dollar is not collateralized by anything anymore. And that was done because the trade-off was the network effect and like the control effect. The only way for the dollar to have achieved its current sort of world reserve status was basically by not having collateral as the basis for it. So that's where the scalability proof comes in, but like that has side effects, right? Like if you look at the national debt today for the United States, it's just weird and doesn't, like, you can't reconcile the fucking thing, like, no matter what you do. So, like, there's a consequence, and you don't know that consequence sometimes for 10, 20, 30, 40, 50 years. And, but I don't think it's so straightforward to find, like create a collateralized version of some sort of currency that people are going to want, so long as something like the dollar with its yield exists, right? Like the competition is fierce, essentially, and it's hard to beat that.
You're absolutely right. And I know that so many people are focused on stablecoins. I'm like completely ignoring that in the industry right now because I don't think that's where the future adoption looks like, because the most efficient, like the most efficient it can be is having 0% collateralization. It is absolutely a trade-off between security and scalability. And so the ones that you can see take off and scale really fastly are the Terra Lunas, where you don't have the security, where it's not actually collateralized. And that's what makes a good money. There were issues with the gold and silver standard. And while I'm very much against how terribly we've done spending, and speaking as a U.S. citizen, and what all has happened with the dollar, look at the world the dollar created. Look at how efficient our world runs. People are like, oh, Bitcoin's real money. No, it's not. Bitcoin is terrible money. It might be a good store of value, but it can't be a good money if it is deflationary. You need money to devalue over time to incentivize investment, to incentivize lack of not being stagnant. And you had to have just massive money printing. But in DeFi, if we're going to build a different system, you have to understand those risks. And I don't want to build an ecosystem knowing that I can get rugged at any time from this unneeded dependency. And so I'm not going to rely on any type of stablecoin like that.
Wow.
Yeah, okay. The world is basically a petro-agro dollar digital system. Like, it's one big giant machine at this point. And like it's both incredibly like powerful in terms of the types of things that get produced from that. Like, look at AI today, for example. Like, these are sort of the side effects of that system. But on the other hand, the flip side of that is like, it's an extremely fragile system. Like, we're one solar flare away from like complete human decimation, meaning like complete breakdown of food production and like energy production on this planet. You're like one little glitch away from just a total fucking
Cephii, right? don't wreck the buzz. I mean, don't wreck the buzz. I mean, I know we're all doomed. Mate, I know we're all fucking doomed, and the end of the world is nigh, and we're all there.
But the simple point is, like, it's just their trade-offs, right? And this is true in if you're building a crypto system too. You can trade off scale for security, et cetera, but there's some fragility that you introduce in the system, depending on what trade-off you pick. And the problem is like, none of us can see the future. So like, I might be a AI doomer, and you might be a solar flare doomer, and maybe none of those things happen and we get hit with a meteor instead. So the problem with designing crypto systems is that like, which security problem is going to kill you, or which lack of scalability is going to kill you, we don't know a priori. And that's why it makes it so difficult to sort of design these things. Like, let's say you're a crypto designer and you're like, hey, you know what? I want my thing to grow really quickly. So I'm going to put together some cool Ponzi-nomics or whatever, and it's going to grow really, really fast. Now, you could do that, but then like that might have consequences in terms of like the longevity of the thing. It might crash quicker too.
Well, so in these trade-offs, though, it is always better to choose scalability over security until it isn't. And it takes an ungodly amount of time until that's the case. I mean, have you guys even heard of JED before this? No, but you've heard of Terra. And that's because Terra chose scalability over security.
What did you say? Right, I need to double check myself here, because we have got a security expert coming on, an Israeli security expert coming on tomorrow. You said that you have to focus on scalability over security, Eric, yeah? Is that right? The trade-off?
I prefer focusing on security. However, realistically, it is always the right choice to focus on scalability over security until it isn't. And when it isn't, that's when you see giant capitulations. Terra, FTX, they were focusing on scaling. They did great. And all the people who made those decisions got stupid rich by making terrible decisions, which makes it the right decision for them. There is a ton of money in running Ponzi's, and it's always going to be more efficient to run a Ponzi than a solid business. And I hate that that's true, but I'd be amiss to not acknowledge that's the case. And that's why I'm okay. That's why I'm okay with high stake and rewards early on. But you have to use the leverage, the opportunity that you get from scaling to then grow something that's secure. You have to get this kind of marketing in place. And marketing is always an ungodly expense that, in my opinion, isn't really justifiable. But you can build something secure and nobody's going to come and use it. So you have to kind of find some kind of mix. And I hate that, but that's what it is.
I think they'll agree.
This is a problem that we find at a basis of market capitalism, right? That's not just an incentive structure that exists within crypto. That's an incentive structure that exists within any form of business construction, right? You're always going to be incentivized to scale regardless of the consequences, whether that be environmental, whether that be community damage, whether that be breaking families apart, whatever X is, right? Your incentive is to earn income because businesses are essentially unethical. They're aethical. They're not good or bad. They are money-producing machines. As long as that incentive is to be a money-producing machine, then yeah, that's going to be the incentivization at all points within the business cycle. We need to rethink. Like there needs to be, I guess, you need to restructure the game theory of how you're looking at your businesses or how you're designing your businesses a priori, right? Like I guess we need people that are doing this from a philosophical perspective, not people that are doing this to line their own pockets.
That's why I'm here.
That's why I'm here as well.
I was going to say, you're singing Eric's fucking theme tune here, like whether he agrees with everything or not, like the base points, I'm sure, like Eric, you're like, yeah, 100%.
All of this that applies to crypto applies to the bigger thing. And we're catching along fast, but I get frustrated when people act like we haven't been dealing with this exact stuff for thousands of years already. But we have barely new problems and barely new solutions. Almost everything's been done in some way, shape, or form before. And we need to understand it, and we need to decide how we do want to approach things. We have opportunities to rebuild things better, but also we have more opportunities if you build more Ponzi's and if you make more stupid dog monies. And so I don't make a lot of friends in this space, but I'll still be here in 10 years, and I don't know if they will be. So I'm going to keep trying to do something that makes sense, that I can rectify ethically, and try to build whatever is going to be the next Google, the next Apple. But realistically, money is fake. It has purpose. It is meant to change every couple hundred or thousands of years. There is no like, oh, this is the solid money that's going to last forever. That's not the purpose of money. That's not how money works. And understanding. Are you Kevin
O'Leary's son? Are you Kevin O'Leary's like secret, like abandoned son or something that like we've only just found out about? I think I'm not in this to make friends. I'm in this to make fucking money, dude. You're talking my language, Eric. You're talking my language, Eric. You know.
I'm in this to make a difference. I hope I provide for my family as I do it, but I don't care about getting rich. I'm not in it for that. I'm trying to do something different. And again, I want to leave the space in 4 or 5 years, just do some advising roles and start a church. That's my end game. I've been public about that from the beginning.
I can tell you,
Bruce,
talking with Eric.
Bruce, 1 second. That's very interesting, though. A non-dev person who talks like that, because we've been doing non-dev stuff, and Eric said earlier, oh, it's a smoke screen. They make it like look or sound as like it's much harder than it is. The coding community, like try to, but actually, it's not that fucking complicated when you start going copy and pasta people's code. And learning about how bulk functions work, and learning how to just like change addresses and change functions and actions, and like I know, Eric, I heard you earlier. Like there's a time where these fucking devs could hide and they want a pedestal. That time is gone, dude. That time is now changing, right?
I don't know. I hope so. While I like that devs now have an opportunity to lead and run things, I think it's been a miss that in business for the last 40, 50 years, like the devs do most of the work, but it's the soft skills people that make the most of the money. That being said, there's a reason that soft skills people made most of the money. It is the marketing, it is the deal closers that actually bring the money in. And so we need more of a mix, hopefully leaning more towards the devs than was previously done in prior business. But this idea, like I was in an ecosystem for a while where they tried to have a salary cap of $30 an hour for non-tech people and a salary floor of $100 an hour for technical people. And I'm like, well, I can do audio engineering. Does that make me technical? Like, how do you define this? Like, what do you do for like lawyers or anybody with any kind of legitimate business experience? Like, I'm not gonna work for you for $30 an hour, but you want my work done, so justify that.
I'll say this too, and this is how traditional business has run for the beginning of time, is where, businesses that are top heavy fail really quickly, where you have the people that are working and have the technical skills running the business versus the people that are I think sales runs every business. The people that are actually selling the material, actually getting customers, actually onboarding people are the most important people in the company. And you saw this with Circuit City. As soon as Circuit City started paying the salesmen less, Circuit City went out of business. Why?
I love you guys. I gotta hop on late for a call.
Yeah. And this is the last thing.
Steven, great to meet you, bro.
I also have to leave.
Love to meet you too. Thank you for having me on.
This is the last thing I'll say before I have to leave, because I have to jump off too. That I don't think there's enough salesmen in the space. I don't think there's enough people that are actually selling these products and marketing them the way they're supposed to be. And the Circuit City problem is, I don't know if people are familiar what happened with Circuit City, is that Circuit City was super successful. They had this program with these salesmen that, incentivized them to sell these programs. And they sold these programs and made a bunch of money for Circuit City. And on average, as a college kid, you could be making 50 to 60 grand off selling these plans. What happened is new management got in there and said, these salesmen are making too much money. What happened? Circuit City went out of business because they weren't incentivized to sell these plans anymore. So I think in the traditional business model, you think that, oh yeah, just because the tech people and the management is running this company, that, they're making all these financial decisions and they must be smart, doesn't mean they're making more money because they're paying people less, if that makes sense. So I think we need to shy away from this traditional business model of, the smart people that are actually making the code should be the ones that make the most money. Yes, I understand that because they have a lot of skin in the game, because they are writing the actual, point of the business and actually building the protocol. But again, you have to onboard users, you have to sell your product, and you have to be able to make money. So you have to incentivize the people that make you the money, not the product itself. So
coming from a sales background, Mike. Stephen, one second. Coming from a sales background, I have to reiterate exactly what you've just said, because I remember sitting down like 19, 20 years old, first day of the job, and like the boss explaining, like, you go to see your GP, your local doctor, your general practitioner. Someone sold him the fucking stethoscope that he's going to put on your chest to find out if you've got a fucking lung disease or impending pneumonia. What Mike said there about salespeople, mind, like, don't overlook that. They are the vast majority of the time the most essential people within a particular business environment. If you're in a business where you're selling product, your sales staff, and that's why sales teams get given the greatest we've lost Eric. He had to go. He had to jump. Right. Okay. We didn't get to say goodbye. But literally, sales teams in big companies are given free rein. It's like they're a different entity to the rest of the company. If anyone's worked in sales or been part of that environment, it's like you're like the Wild West, right? You're allowed to roam free and generate your leads and do whatever you want. But salespeople are always overlooked, and they are generally the most important people in the organization. Sorry, Stephen, and bye, Eric. I do apologize.
I was a broker. I was a broker for 3 years. I mean, a broker is just a really fancy name for selling angrily at people. Sorry. Sales are absolutely the most important part of any business. And I think that a lot of traditional business does realize that. If you look at sort of SWS, if you go to an SWS company, yeah, Dev's making 150K, but if you're a good SaaS salesman, man, you're making 500 to $1 million. Right? Like, it's the problem with sales, and the reason that makes sales such a hard thing is that it's just really hard to find a good salesman. Good salesmen are.
But you got to be a people. You have to be a people person. You have to be a people person, and sometimes a lot of these devs, not shitting on the devs, don't know how to deal with people.
It's not just that.
You have to deal with a lot of shit.
It's an expert who's sold on 3 continents and trained sales teams, and I've studied the whole fucking thing. I know exactly. I teach people this shit every day. I mean, is it about the salesman? Is it about the salesman, or is it about the product and the ethos? Which one's more important? Because I've sold shit. So is it the salesman, or is it the fucking product?
I think it's the narrative of the product, right? And I think that the actual the idea that you're trying to separate them, I don't think necessarily works, because you need the product. You can sell thin air. Don't get me wrong. Absolutely, you can sell thin air. But if you do have a product that you're selling behind you, you want to make sure that product is meeting up to the narrative that the salesman is providing. And if it isn't, then you've got a faulty product that I wouldn't feel ethical about selling. Right? So you need those two sectors to work together and in tandem to build both the product and also to ensure that the product's functions are working within the narrative that the salesmen are trying to portray of the actual functions of the business.
I think they're both essential. I think the most successful salesmen in the world, and the United States are ones that sell stuff that's really valuable, and the salesman himself or herself is very valuable as an asset as well. So like you can, a normal guy can sell a really good product and make a good amount of money, but a really good salesman selling a really good product can take the business to a whole next level. And I'll stand by that to the day I die, because I think there are certain skills in sales that you need to know. You need to deal with rejection. You need to know what you're selling. You need to know how to pitch it. How to talk to people and build relationships. And I think sales is massively built around relationships and getting to know people on a personal level. And my father always taught me this as a traditional businessman, very successful businessman in the United States. People do business with you for two reasons. One, they like you, and two, they trust you. The product can be great. It could be the next thing since sliced bread. But if you're some random dude selling this product and they can't trust you, I mean, I don't think they're going to buy it. And people can push me back. And Robo, you might be able to push me back on this too. But
I'm going to ask. Stephen's here, and it wouldn't be RAC FM if we didn't do this. Stephen, is Charles Hoskins the greatest dev in the world, or is he the greatest salesman, or is he a bit of both?
Both.
Oh my God. This is really, really dangerous for me.
That's okay. You don't. No. That's RAC FM. You don't have to go there.
But I'm just going to be diplomatic here, because my feelings about Charles Hoskinson can be made public, and then I will have an entire rabid community of 20,000 people at my throat. That doesn't mean I feel badly about him. I'm like, if I say the wrong thing, that is a realistic thing that can happen.
Don't worry, we'll delete the space. We'll edit it. We'll delete. Don't worry. We'll take care of you.
Charles Hoskinson is a fantastic salesman. What Charles Hoskinson has done better than a lot of founders is build a cogent philosophy that's underpinning his blockchain. Whether he acts in the manner that best exemplifies the philosophy that the blockchain is built on isn't necessarily, I think, it's incongruous, I think is the best way to put it. He acts sometimes in an incongruous manner to the philosophy that he's selling underpinning his blockchain. But a lot of the community, such as ourselves, believe in that underlying philosophy. So we build the blockchain following those principles, or at least we try. Yes, his strongest strength is sales.
Wow. I mean, your man came down to throw down tonight, Brucey, right?
Oh, absolutely. Stephen, he fits right in.
He's a diamond, isn't he? Hey, Mike, I know Eric's dropped and oh, yeah, dude. Oh, and intelligent. But Mike, have you enjoyed talking to Stephen tonight, or what? Has it been decent? Yeah.
Man, it's like I like using the if anybody's seen Wall Street, the second one is a fisherman always sees another fisherman from afar. It's one of my favorite lines, because when you speak to somebody that knows what they're talking about and comes from the same industry as you do, you think kind of in the same way. And we might disagree on some things, but I like to find common ground with a lot of people. But again, it's hard to find common ground with a lot of these people in this space, because they necessarily try to sell you shit. And again, Robo, you're a salesman. I'm a salesman. I can smell it from a mile away, and I'm very good at pretending like I don't know. Oh yeah, great. Oh, that's cool. But yeah, I'm like, man, this guy's blowing smoke up my ass. So I enjoy RAC FM. I enjoy a lot of you guys. I enjoy the people that are in this space and discussing ideas with them. And I'm entitled to my own opinion. I let people know that on Twitter. But Stephen, it's very rare to find people like you in the space that, are willing to come up here and talk. I think most of the financial people have either left or are still in the space and kind of tread lightly. So
thank you. Thank you so much for those kind words. And guys, I am going to duck off because it is 1:10 in the morning and I'm starting to get sleepy.
Yeah, man.
We are going to end this space now as well.
Yeah.
So.
Yeah.
I want to say a few words to Stephen. He's been a diamond, an absolute diamond. Because something, we all know each other. And he came in tonight, not knowing anyone or what we were going to be like. But I keep saying this about the RAC FM interviews. When we ask if you want to come on the show and you're like, oh, can we do a pre-screening interview or blah, blah. Literally, we're in the group chat and we're just like, oh, well, that's a fail fucking. We don't even bother with people who are like, well, can we go through what you're going to ask? And I said to Stephen, do you want to come on? He went, yeah. Like, it took him like a millisecond to say yes, right? Stephen, I hope you can come back in a couple of weeks. Listen, no, dude, we do a Friday show. So I think it's around 10 p.m. Friday, your time, in a couple of weeks. Yeah, dude. Well, it's a closed mic, and it's only like the host, the panelist. Come back on in a few weeks, Stephen, and we'll talk to you like a little bit more about like history and just general like crack about everything that goes on in the industry. It's like tonight we're like really professional. The Friday show we're like shit talk. So I'd like to get you on to be at the shit talk, dude. You know.
Send me an invite. We'll talk about it. Send me a DM. We'll talk about it, and I'll definitely swing on by. It sounds like a lot of fun, mate. I enjoy talking to you guys as well. You know, it's a very intelligent group of people here, and I've done a lot of spaces, and let's just say a lot of them don't involve a very intelligent group of people.
Lovely. God bless you, Stephen. You're lovely. Right? You're welcome back anytime, son. All right.
You know he was talking about Mike and Eric.
Thanks so much, guys. We'll talk soon.
Yeah. Take care, Stephen. What a great space, mind. What a great space. I'll tell you what.
Banging fucking guest, man. Gigabrains. Just did you guys notice what happened with the space when you started talking about stable coins? Had fucking 4 people talking in the mouth of each other all of a sudden, all being so civilized and educated. Fucking lost the binkies all of a sudden. I loved it.
Well, because everybody has different opinions about stable coins. It's like there's no reason to hold them. Like, I mean, if you in the United States, you could literally get 4.56% on your money. Like, why would you hold stable coins? It makes no sense. Zero. And I understand, like, you know, the UST thing, and it's, you know, Cephii was in here, which is great. And Cephii is one of the more intelligent people in this space that doesn't really talk that much. But it was
what? We have a standing joke, and I think Cephii knows this. We have a standing joke that Cephii comes in, and then he makes it into a Cephii space, and he can just talk for like hours.
Really? Oh man, maybe I haven't fucking
bro. I once did a 47-minute diatribe with Cephii. I'll tell you what, I mean, I was like, you know, Tom Hanks when he's on the island with Winston. You know him and Winston when he's on the island and he's like, that's it. And then he gets rescued.
Man, is that you mean that's the Australian version? It's Wilson. Wilson,
the football, Tom Hanks, isn't it? When he's
the Australian version.
Wilson, not Winston. Robo.
No, Wilson. Is it Wilson? Oh, see, I'm back home.
What the fuck? Robo, you gotta go to bed, man.
Wait, no, I'm back home. Because I'm back home now, and he's Winston, like, come to greet me. Like, I have the greatest dog in the world. He's so nice. He's just like a big ball of fluff, man. But I'm going up to Winston, but I'm talking about Wilson. But you know what I mean, though, yeah? Bros, tonight, Mike, has been better than I ever thought. Like, I like literally, Bruce, tonight's been a banger. Go on, finish it off, dude.
An absolute banger, man. Mike, do you have some last words before I finish it?
No, I just appreciate you guys having me on here. You know, I always voice my opinion about the space. I'm like, again, I really don't care about what people think. I kind of say what's on my mind. And, you know, the pre-screening process was, you know, a DM, and I was like, yep, 100%. I'll be. I don't need a script. You know, like, again, I'm not. If somebody tells me one thing and says another, like, I'm going to speak my opinion, and I'm not going to speak, you know, what somebody wants me to say. So I appreciate you guys having me on here, and that's really, you know, I look forward to more spaces.
Yeah, man, that was my next question. If we should do this,
never lose. Bruce thought, he should never lose the honesty. I've just got home, by the way. He should never lose that honesty, because, Mike, listen, on a space, you can fucking smell. You can taste barefaced honesty. You can tell when someone's being themselves and when they're not. So thank you very much from me for just coming up and being you, like, dude. Big respect.
I'll say this too: you shouldn't you should never trust anybody in this space, including myself. Like, you don't know who these people are in real life. Like, you should always tread carefully. And if somebody, you know, and I literally openly voice my opinion about community. Like, I changed literally my subsection of my professional profile to financial services from community, because community has just been hijacked to just dump on people's heads. So yeah, that's it. Spicing it up for next RAC FM.
Absolutely awesome, man. Thank you, Mike. Anyways, this was the NEC Syndicate financial breakdown and more report space with the Gigabrains and the Giga Chats of the pessimistic, realistic honesty. Everybody have a fantastic night. This was Bruceman hosting.
There's this principle in like Taoism where just like the more you fight something, the more like the opposite of what you want, inevitably it kind of starts to happen.
Chirping on the bird app, listening to nerds flap, wondering why the fuck my timeline's so cursed. It's like everybody's holding heavy bags in Web3. That's why they can't fly, they just drowning in the bird bath, fishing for some dry powder. Watch how we ignite the tower, blowing up their bank accounts, forgetting how to fight the power. Y'all don't even realize how deep this shit goes. They preaching open source, but don't listen to the code. And now it's mutiny, community, uprise. There's no more humility, futility, plus size. Motherfuckers leaking from the wrench down to the bare metal. Which side the line you bleeding out on when the dust settles? Motherfucking west side shit, needle and noose. Sticking with my armory, and Beto and Bruce. Reppin' psychedelic artistry, believing the truth. Like these motherfuckers even need a reason to sue? GM fam.
Really worth all the effort? Is it really worth all the fighting? Is it really worth all the drama? And the answer, I think, is a clear no.
We started using Zoom, now we finna zoom out, teaching all these plebiscites what this game's really all about. Little baby bitches when they choose to have fits. All you're left with is kibble when you lose all them bits, and that kibble's just sawdust. The shit is all rust, not a great look, you're what we call all nuts. And I for one did not see that coming. Cracking open books, yo, that's a lot of money. Meanwhile, over here rewiring features, more critical thinking, less knee-jerk, more evolution, less shitcoin preachers pretending to be teachers. Y'all just predatory leeches. I mean, please, just look at the track record. A bunch of VC rap fucks sucking up the cheddar. The recipe is 2 steps, rinse and repeat. Now we all in your butts and we bring in receipts. GM fam, have a seat.
If you're listening to this, my plea to you would be like, don't have to take a side on it. Just say like, is it really worth this war of attrition? It might cost us a lot more than what can be gained by like fighting this to the bitter end. And sometimes it's better to just like move on.
Where the fuck did I put that? You know, I hate it when I throw something away and then someone's like, hey, you have that thing? I'm like, no, I threw it away. And now here I am. Ugh. Digging in the fucking trash again. Trying to find this goddamn shit. Y'all throw some weird ass shit away. Didn't even bring gloves. It's like all over my hands and shit. It's fucking gross. Ow! The fuck put a needle in here? You guys. Yo, yo. Yo, yo.
Yo, yo. Yo, yo, Eric. Welcome, man. Welcome.
How you doing, brother?
I'm good, man. So there was some communication issues, apparently. But we're here now. Everything's good. How are you, Eric? Good morning and welcome. And sorry for the delay.
No problem. I'm doing all right. Apparently the
awesome.
The econ papers dropping on the website like any minute right now.
Oh, I've been waiting for that, man. I heard you on the Joe space with Tank talking about it. Yeah, so that's exciting.
I wasn't patient. I just sent the PDF out to some people yesterday. But we'll have a proper link here pretty soon.
Are you happy with it? I guess you are, since you're gonna publish it.
Yeah, I think it's pretty good. There's always more stuff we can add, but it's 50 pages. There's nothing there.
Okay. But yeah, Mike is up, Robo is up, Steven just came in. So let's get this going.
Is this the same link as the one I had shared?
Yeah, it should be.
All right, sick.
Don't worry, man. We just started 2 minutes ago, so we're right on time.
Would you like me to do this through the Wi-Fi official?
That's up to you.
Oh, Stephen, you're good, man. You're good. You're okay, mate. No problem at all. Guys, let me explain very quickly, and there might be a little bit of background noise until I reach home. Bangkok's a bit crazy at times. So there was a bit of confusion, actually, for the first time ever between Bruce and I. And it's because he kind of booked Mike and Eric, etc. And normally, because I'm off tonight, I'd have been hosting a Tuesday one, but I've got 2 lined up for tomorrow. And because Bruce had organised like the original guests and everything and set it up, I was totally convinced that he was going to run the show tonight. And I was like, all right, okay. And then he's like, are you starting this space? And I'm like, dude, come on, I'd never take this show from you. And he's like, what? Bruce, I'd never do that to you. Not when you set it up like that. Yeah.
Yeah, I think we should talk about this in another place because I was asked to set this up, so I just did it. Anyway, it's a brilliant space with Eric and Mike, man. I don't know Steven, dude. I don't know who you are, man.
Well, tell you what, we're going to find out. So, Stephen, we've literally been that busy that I haven't spoken to the guys at great length. But Bruce, Stephen was introduced to us from the Reach Metaverse space last week. I believe, Stephen, that you had something to do with our tokenomics. Is that right? So, Stephen, we kind of know Mike and Eric quite well. You can probably tell that. Do you want to just give a quick introduction to the group about yourself, your background? You don't have to go into great depth. Just give us a quick overview, mate,
Yeah, absolutely. Thanks so much for having me on, guys. So my background is originally, first I studied physics. After studying physics, I moved into hedge fund trading, and I was working as a bonds trader, where I was specializing in short-term interest rates. And from short-term interest rates, I was also doing treasury notes and interest rate swaps. From there, I went to work in essentially brokerage. It was kind of like financial advisory brokerage, helping develop income streams for using bonds and developing income stream portfolios with people. I started up a fund managing some monies in DeFi in sort of 2019, heading into early 2020 when the DeFi summer hit. We did very well. But whilst using a lot of DeFi products, I started noticing a lot of problems with these DeFi products, both from a structural perspective, a design perspective, just a lot of issues that I saw, which we can talk about later, of course. And I decided to design my own DEX and my own auto harvester to try and implement solutions from a tokenomics perspective to the problems as I saw them to the current implementation of DEX tokens. From there, I've been working in the Cardano ecosystem now for almost 3 years. So started that in 2020 with Wi-Fi. And now I've been in the Cardano ecosystem for 3 years. I run my own tokenomics consultancy. I've worked with a plethora of projects in the Cardano ecosystem. I'm currently working with Noom. I'm working with Drip. I've worked with Cephii. I'm working with a lot of NFT projects as an advisor, and I'm an advisor to Reach as well, and I design their tokenomics with them.
Bro, and that is exactly why you're on this fucking space tonight. I mean, Eric, Mike, you know why your man's here, right? Eric's a tokenomics there, dude, as well, right? Right, Eric?
Yeah,
you're all about the numbers.
My man, right up my alley. Literally just invented Astrovault for the same reasons. I'm launching my economics paper for Archway right about now. It's about to go push live on the website. I
Congratulations.
Also do tokenomics consulting. I actually have one really big name group that people don't know is coming to crypto yet, but I can't talk about it for another 2 months. That's going to be some fun, but it would be great to hear about more projects in the Cardano ecosystem.
I'll tell you what, I'm just going to say it, that we've got a couple of ladies in the room, so shout out Wendy below. She's a Cosmos nerd as well, but we've got our co-host here, Bbandz. Hello, do you want to say hello to the guys?
Hello to the guys.
I get wrong for this all the time. I keep saying to Bruce, say good night to the guests, and Bruce like, great, and thank you, Robo.
Hey.
Bbandz.
Okay, go ahead.
You excited? Are you excited?
I am. I feel really bad. I have to hop out for a little bit. I have an appointment with the kids, so I just wanted to come in, say hi, but I have to come and listen to the show later.
All right.
Family second. Family second. Work first, always.
I tried that, but my family tried to leave me.
Oh shit! Change of plans.
What she's going to do is just lower the IQ on the host panel by dramatically by a large amount. I think, like Bbandz.
Well, I thought I was. I thought I was safe. You said hi IQ only, and I was like, oh, okay, then it's fine. I can go to this appointment, no problem. You guys are all set.
Well, it's the first time that we've probably been completely out of our depth, but actually RAC FM's job, most of the time, is to facilitate conversations. And I do know that there's been, really, Bruce has probably got a few words to kick off, but I was really hoping that maybe Mike specifically might be able to fill Stephen in on some of the crack that we've had regarding what's happened in regards to certain tokenomics with proof I mean, we could call it proof of stake. We prefer proof of selfishness. Over the last week, we've had some real issues with founders and millions of dollars. So, Stephen, guys, I haven't brought them up onto speed as to what brought on this particular, discussion tonight. Bruce, before I ask Mike, just to fill Stephen in on what happened last week, without any names or anything, just a hypothetical founder situation.
TerraSpaces.